New York City, I'm Brad Smith alongside Shauna Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
We certainly have a lot of ground to cover this Wednesday morning, so let's get right to it. Stock futures declining on the first trading day of May. The move lower coming on the heels of Wall Street's worst month of the year. The next big test for the market, well, that's going to come this afternoon, the Fed's rate decision. Investors are going to be closely listening for any hints of rate cuts later this year.
And a fresh read on the labor market. Private payrolls adding 192,000 workers in April, according to payroll processor Automatic Data Processing, ADP, as they're known in your hood. Now, the data showing signs of a resilient labor market, so let's get to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Jennifer Schonberger, Dan Halley, and Brooke DePalma have more.
Futures edging lower after April closes out its worst month for 2024, with the tech-heavy Nasdaq sinking 2%. The next big test for markets, the Federal Reserve's policy meeting. The Fed is widely expected to hold interest rates steady this afternoon in the face of higher than expected inflation data in the first quarter. Investors are keenly watching Fed Chair Jay Powell's press conference this afternoon for answers to questions on just how much the central bank's outlook for inflation has shifted and what that means for when and how much the Fed could cut rates this year.
Plus, Amazon's earnings impress Wall Street, the tech giant delivering strong Q1 results driven by growth in its cloud computing unit and advertising business. Amazon is seeing strong demand on the AWS front, with customers signing up for longer deals with bigger commits, many with generative AI components. The tech giant expects its CapEx to increase meaningfully this year as Amazon continues to spend big on its AI capabilities.
And shares of Starbucks sink on disappointing Q2 results. The stock down this morning roughly 12% in pre-market trading after missing Wall Street estimates across the board, posting lower than expected revenue, earnings, and same-store sales as consumers around the globe pulled back on spending, with the largest decline in sales coming from China. Now, the coffee giant also lowered its 2024 guidance to reflect ongoing underperformance in the quarters to come.
All right, we're about 30 minutes away from the market action this morning. Let's load up some of the major averages, and we've been tracking the futures here. Get out of here, Mattel. All right, ultimately, let's just get on over to there we go, the Dow Jones Industrial Average, but that is yesterday's average here. Okay, so somebody's hopping into the interactive here right now, but as we scroll down, the Dow futures right now lower by about 0.1%. The Nasdaq 100 futures, you're seeing that down by about 0.4%, and the S&P 500 futures pointing lower by about 0.3% as well. Big story of the day, though. Everybody is going to be watching the Fed here this morning and just giving a look at some of the heat map data that we're seeing, extended hours coming into the start of trade as well, especially on a sector performance basis. You're seeing more red than green right now, industrials, and it looks like XLB materials, I believe, also the only main kind of gainers at this point in time right now.
And as you can see, technology, one of the worst performers here this morning. When you take a look at the semis, some of the trading action that we are seeing there, a lot of this tied to the losses in AMD, and also what we heard out from Supermicro here ahead of the bell, certainly weighing on today's trading action. When you take a look at AMD, that loss there just about 5.4% in the pre-market, disappointing investor expectations. We know very, very high hopes for both AMD and Supermicro heading into these prints because of the excitement surrounding AI. Supermicro is also on the screen, probably one of the smaller names, but also under pressure here this morning. So again, another name to keep in mind, and look at that, a decline of just about 10%. Let's kick it off with this top story of the day, and that is the Fed's decision on interest rates. The federal funds rate currently sitting at the highest level that we've seen in more than 2 decades. Wall Street eager for any hints of when we will see that first rate cut. Yahoo Finance's Jennifer Schonberger has the latest on that. Jen.
Good morning, Shauna. Fed officials reconvening just moments ago for the second day of their 2-day policy meeting here in Washington, where they are widely expected to hold rates steady in the range of 5.25% to 5.5% on the back of higher than expected inflation data in the first quarter. Fed watchers have been pushing back expectations for the timing of rate cuts as questions are starting to shift from when the central bank will start to cut rates to whether the Fed will cut rates at all this year. Analysts now expecting only about 1 to 2 cuts this year. Now, there will be no new interest rate projections this meeting, and few changes are expected to the policy statement. So all eyes will be on Fed Chair Jay Powell in his press conference for just how much the central bank's outlook for inflation has shifted and what that means for when and how many rate cuts we may see this year. Powell is likely to hold the line, maintaining an easing bias, but reiterate his message from 2 weeks ago that it will take, quote, longer than expected to achieve the confidence needed for inflation to come back down to the central bank's 2% target, essentially signaling that rates will be held higher for longer. Now, specific things to look for. One, whether Powell reiterates the Fed will cut rates, quote, at some point this year, or whether he dials that back. Also, whether he says the March interest rate projections are outdated, if he's worried inflation is stalling or watching for signs of reacceleration of inflation, and whether he now thinks pain is needed to bring inflation back down to target. Guys, this decision coming down at 2 p.m. this afternoon, followed by Fed Chair Powell's press conference at 2:30. Back to you.
All right, we're going to be sitting on the end of our ergonomic chairs waiting for that announcement. Jennifer Schonberger, thanks so much for teeing up what we're going to be watching, and the market's going to be paying close attention today as well. Appreciate it. Let's talk a little Amazon. Amazon shares getting a boost after seeing net sales jump 13% in the first quarter from a year ago, and saying its AWS business is on track to generate $100 billion annually. The e-commerce giant's outlook, though, flashing some warning signs about the state of the consumer. Amazon now projecting its second quarter net sales to come in between $144 billion and $149 billion at the top end. That's below the expected $150 billion here. But there's one thing within this particular earnings call that took place that I think a lot of investors are also keeping tabs on, at least from this quarter on out. And it's really on the CapEx side here. Right now, they had about $14 billion of CapEx in this most recent first quarter. And they said, the CFO, Brian Olsavsky, said that they expect that to be in the low quarter for the year. So it could ramp up further, and it's really on the demand that they're seeing, especially as it comes to AWS. The more demand that they see there, the more they have to procure new data centers, more power, more hardware, and they spend most of the capital up front. And so that's where a lot of that CapEx is going to be going towards.
Yeah, exactly. And at least for right now, the street seems to be brushing it off. And I think a lot of that has to do with profitability here of Amazon and where they see that CapEx going and exactly what that's going to do to the business. Because when you take a look at the street's reaction, you take a look even at the stock reaction here this morning, but more specifically what analysts are saying, many of them very upbeat about this quarter, reiterating, there are several of them reiterating why Amazon is its top pick and tying it back to that growth that we're seeing here in AWS and exactly what that AI spending plan looks like and could potentially look like here for Amazon for years on out. And it certainly is enough to offset some of that lackluster growth that we are seeing within the e-commerce business, within the retail space. And they're saying that right now that isn't that big of a concern given the growth, the reacceleration that we're starting to see within AWS. So we will be speaking with Brent Thill later on in the hour to get his take on these latest earnings results. All right, let's switch over to Starbucks because shares are selling off this morning, a slowdown in same-store sales for the first time since 2020. Well, that prompted the coffee giant to lower its full-year guidance. Starbucks' CEO calling it, quote, a highly challenged environment. You can clearly see the reaction in the share price today, off nearly 13%. Brooke DePalma very closely following this story for us. Brooke, what's going on?
Yeah, good morning to you both. Stifel analysts calling these quarterly results a bitter bean to swallow. And I think that says it all. Really, this report shocked Wall Street with just how far same-store sales came in lower than expected as consumers really pulled back across the globe. We saw global same-store sales drop 4%. U.S. same-store sales drop 3%, largely based off a more cautious consumer, especially among what they're calling a occasional consumer pulling back from purchasing at the coffee giant. Menu innovation like lavender latte saw similar success. What they said was the pumpkin spice latte, but it didn't move the needle enough as far as same-store sales go here in the U.S. We also saw those boycotts from the Middle East conflict. Conflict in the Middle East did draw international sales lower. In addition to that, we continue to see this ongoing challenge in China for the coffee giant. They said that it's a highly promotional environment, and they too are seeing an occasional customer pullback a bit there. Lots of stories to tell from this quarterly report.
And even more conversation coming. Thanks so much, Brooke. Stay tuned for our interview with Starbucks CFO Rachel Ruggieri coming at 9:40 a.m. Eastern. You do not want to miss that. Plus, we're also tracking AMD shares this morning. They're in the red pre-market after the semiconductor giant reported first quarter earnings sales that beat expectations but gave lighter than expected guidance for Q2 on what it sees as falling demand for its gaming chips. To break down what we learned from the earnings report, Yahoo Finance reporter Dan Halley is here. Hey, Dan.
That's right, Brad. There were three big things to look at when it comes to AMD's earnings. It's really the data center, the PC sales, and the gaming sales. Now, on the data center side of things, they saw a large increase, although maybe not as much as Wall Street was hoping for. They've seen huge blowouts from NVIDIA over the past few quarters, and while AMD did increase their data center business significantly, it wasn't as massive as something like NVIDIA. On the PC sales side of things, they saw an improvement year over year. This is a trend that we're seeing across the general PC landscape. Microsoft saw better than expected improvements to its Windows OEM sales. Intel saw improvements to its client sales, and now AMD seeing improvements to its client sales. This is the first quarter, Q1, of growth for the PC industry in 2 years. And then finally, on the gaming side of things, this is really the big headache for AMD during earnings. They saw losses year over year in terms of overall gaming card sales. Those are the sales of cards that go into things like laptops and desktops, as well as their custom semi sales. Now, this has to do with things like the PlayStation as well as the Xbox. Because those systems are now into their midlife, entering later life, they're starting to see sales taper off, and as a result, that's hitting AMD's bottom line. And so they barely missed on expectations for the coming quarter as far as revenue. But I think the big thing here is that data center is growing. They did say, though, interestingly, that they're having trouble hitting demand. So people want their chips, they just can't get them to them in time.
All right, Hallie, thanks so much for breaking that down. Again, a top trending ticker here on Yahoo Finance this morning. Well, we are just getting started here on the morning brief. Coming up, the earnings parade, well, it's continuing. A huge miss here from CVS. It's sending shares lower by about 13% in the pre-market. We will explain how higher medical costs are impacting the industry next. Plus, Kevin O'Leary wants to buy TikTok, but what exactly are his plans for the company and how much is he willing to pay? He will join the show later this hour. And later, cannabis stocks are rallying after the Biden administration's move to reclassify the drug. But is it enough for the industry? And what comes next? We will be joined by the CEO of Curaleaf in our brand new show, Catalysts. We'll be right back.
The FOMC, we're not going to see any surprises there. They're not going to do anything. And, I think they've made it pretty clear the higher for longer narrative.
I think there's real risk that the Fed's not going to be able to cut rates at all this year.
We don't think the Fed pivots from their pivot. They pivoted in December. We don't think they're pivoting back to a hike.
No hike.
I don't think there's a hike, but they could stay here a long time.
Those are the perspectives ahead of the Fed decision at 2 p.m. Eastern time today. The central bank largely expected to hold rates steady. All attention will be on what the Fed signals for the rest of the year. Fed Chair Powell saying just 2 weeks ago that the latest economic data has, quote, clearly not given us greater confidence in inflation reaching that 2% goal. For more, we're joined by Willem Sells, HSBC Global Private Banking Global CIO. Willem, great to have you here with us this morning. What's your anticipation going into the conclusion, I should say, of today's two-day meeting?
Well, no cut today. I don't think anybody is looking for this anymore. But the only thing that you really, as an investor, need to figure out is whether you believe there will still be a rate cut this year at all. Because the market has now completely shifted from pricing in 7 cuts to just 1 cut in December. So as long as you think they're going to cut before that, it's going to be positive for markets. The Fed is already out with quite a lot, of caution. As you mentioned just before, Powell has signaled that they need more evidence, before they will cut. But that is already really in the market. So he would need to almost rule out a cut this year or insinuate hikes, which I think is very unlikely, for it to be negative for markets.
So, Willem, does that tell us that the market's repricing here of the Fed rate cut path, what exactly that's going to look like? Has that gone a bit too far at this point?
I think the pendulum has swung quite far. I think it is more difficult for yields to come down very quickly. But I do think they have achieved levels which are quite attractive to lock in. So we do continue to put our cash to work. We're seeing good investment flows from our clients on this, either in investment grade bonds or in structured products, which incorporate on top of that some option income, and obviously also equities, because let's keep in mind that the other side of the coin of this hot for longer is relatively strong for longer. Earnings are very well supported, and you see a lot of analysts upgrading earnings expectations.
And so the earnings expectations that we've heard thus far, it's really been this theme of where demand is still remaining strong. Where are you hearing from companies that there is weakness in demand or some deterioration in the resiliency of the consumer, and even on the business spending side?
It's relatively broad-based, I would say. So certainly I'm encouraged by the fact that a number of blue chip companies have entered into contracts with large cloud providers and so on to really underscore that AI is real. And clearly that is important, but also earnings momentum is broadening. So financials, industrials, and so on, are benefiting, from that broadening of demand because of that resilient growth. But what I'm seeing as well, and especially for your U.S. Listeners, important to underscore that earnings drift is actually also, supported in other areas around the world. So we think investors should broaden not just their sector exposure within the U.S., but also their geographic exposure.
So then, Willem, where more specifically are you seeing those opportunities? And then when you take a look at a day like today, when obviously there's a risk-off mode happening right now in the market, is that something that maybe you don't expect to continue here for the weeks to come?
So I think today is obviously a very special day, with the Fed, decision, and especially I think, more than the decision, the press conference and what, Powell sort of communicates in terms of any further change, in tone or maybe a retracement on his message. But I do think that in terms of the opportunities outside of the US, we see them, in Asia, and there we take a diversified approach. So China's economic growth probably going sideways, a cheap market, and you're seeing a little bit of an uptick there recently as maybe some people dip in their toes, but we continue to diversify there. We see good opportunities in India, in Indonesia, in South Korea, and in Japan. So a broad-based approach more and more, makes sense for investors in our view.
Just to bring this full circle, if we only see one rate cut this year in December as the market is pricing in, what does that hold for 2025 from your purview?
So, that means that, we need to, if we only see one rate cut, we do think that we will, then potentially see further rate cuts in 2025 as we, get some further progress on CPI. Some of the, sticky things in the CPI measure are backward looking. So we see a number of rate cuts, but that being said, it's harder to get gains on equities from a price earnings valuation multiple perspective. So you need to look for that earnings. Those earnings to drive the equity market. But as I said before, in an environment where that earnings potential is broadening, we see many of those opportunities. So we're not too worried. We do think that equities merit a continued overweight.
William Sell, it's always great to get your insight. Thanks so much for hopping on and joining us here this morning. HSBC's Global Private Banking Chief Investment Officer. Thanks. Now let's get to more on earnings. CVS shares is sinking after falling short of earnings and revenue expectations in its first quarter. The company also slashing its full-year profit outlook, citing rising medical costs. You can see shares under pressure here, off just about 13%. Anjali Kamlani standing by in the newsroom with the latest on that. Anj.
That's right, Jonna. CVS really hitting a new low, really in the past decade. Looking at what the company cited, which is the medical loss ratio that is higher than anticipated, despite the fact that they have the increased utilization of services, and that includes across the portfolio for its healthcare services and clinic. And that's something that has been a focus, but in particular, the insurance side, that's where really the pressure is coming from. Medicare Advantage rates have been cut in the last year and likely will be in the following year, and that's what CVS is focused on. They've adopted a motto, margins over membership. They're looking at potentially losing membership in the next year as a result of repricing their Medicare Advantage plans. And that's something that's going to be a focus, not just for CVS, but for the entire industry as they try to sort of balance out the pressure they're getting from the federal government with those prices. Meanwhile, we're also looking at what the clinic side of things are. They've had increased utilization, as I mentioned, which means more services coming in, but also higher utilization of those insurance dollars. In addition, they're looking to expand what their service offerings are. Oak Street Health looking to expand the number of locations. And that's coming at an interesting time since we just heard yesterday about Walmart pulling out of the primary care health space. And that's where CVS looks to be doubling down. So a lot of really interesting moves this morning coming from CVS at a time where we're seeing a lot of shifting and moving parts in the industry. And clearly the company under pressure looking at ways to regain its 4 to 5% margin. Executive said on the call this morning that next year is when they will start what is potentially a 3-year journey to regain those margins. So a lot going on for the company right now.
And a lot in the space right now for healthcare. I'm taking a look at PFE shares, Pfizer this morning, moving higher by about 2.7%. They actually raised their full-year profit outlook. What have you seen within this report?
Yeah, so Pfizer is an interesting story because they're shifting away from those COVID revenues. Of course, a lot of investors are still kind of wary about that. They think that the COVID revenues are pretty conservative, as well as are concerned about the fact that Pfizer doesn't have any near-term profit makers, if you will. A lot of its revenues coming from products already on the market, and they're worried about what the pipeline looks like. So that's where the focus for the story for Pfizer is. While they did have good numbers to report and they have increased their revenue, investors are still kind of wary, mostly neutral on Pfizer right now. So that's one to watch as well.
All right, Anj, thanks so much. That name up nearly 3% here ahead of the open. Well, New York Community Bancorp shares are surging this morning after giving a better than feared outlook for the next 2 years. Plus, charge-offs and money set aside for potential loan losses declining during the quarter. And that's helping to offset ease some of the worry surrounding the bank's exposure to trouble in the commercial real estate sector. The company CEO saying that, quote, while this year will be a transitional year for the company, we have a clear path to profitability over the following 2 years. The company, though, did still post a loss of $327 million for for the first quarter. Shares of the regional lender are down over 70% so far this year. The company slashed its dividend, also set aside more money for loan losses back in January, which initially sparked some of the concerns surrounding the name. So the update that we're getting today, and especially what they set aside here for loan losses, not as large as the street had feared, that's helping to boost the shares in the right direction today. Well, we are just minutes away from the opening bell on Wall Street after a slew of earnings reports this week. We're taking a look at how the trading day is shaping up. Doesn't look too promising here, at least right now. You got all three of the major averages on track to start the day in the red. We'll be right back.
All right, we are just seconds away from the opening bell on Wall Street. We're taking a look at the futures here right now. We are lower across the board here. We'll get you a broader check on the markets after we see that opening bell here in a hot second. But there you're taking a look at the bell ringers. You've got Checkpoint and the Nasdaq and Viking Cruises at the NYSC. All right, tell us your Viking Cruise experience. Why not? Sound off on Twitter or X. Just, let us know how it goes. Anyway, I mean, you know people that have gone on a Viking cruise.
I do. My parents went on a Viking cruise. They said that they had a lot of fun. Also, my in-laws recently. I thought about that.
Maybe that's where I start with my cruise experiences.
There you go.
You know I'm not a huge cruise person.
I know.
They tried to throw me on a cruise last year.
It's a smaller boat. It gets you a little bit more exposed. You get to see what the cruise life is about, and why not?
I'm into that. All right, let's do a check of the market, sponsored by Tasty Trade. Now that we've got the opening bell taking place here. We're taking a look at some of the major averages out of the gate right now, lower to start off the month of May. The Dow Jones Industrial Average hyper waffling on this Wednesday, if you will, trying to make up its mind between gains and losses, flat, just barely to the upside right now.
Yeah, exactly. You have the Dow right above the flat line here. You have the S&P trading down off just about 0.1%. Taking a look at the Nasdaq, that is also under pressure this morning. I wanted to take a look at the sector action because that's really the story playing out in the market here this morning. Much of those losses being attributed here to technology, also healthcare on the heels of some of those disappointing results that we got out the bell this morning. But again, technology, the worst performer of the major averages, actually right along with healthcare. They're pretty much tied there. Some of the losses, though, within tech is attributed to the chip sector. We're seeing some pressure here when you take a look at AMD. That stock opening up just off about 7%, so huge moves to the downside there. And then also when you take a look at a name like Supermicro, that is also under some pressure here this morning, off just about 11%. Very high expectations on AI growth going into these names, so we're seeing a bit of selling action on the heels of this news. All right, we also want to continue our coverage of some of the big movers at the bell. Yahoo Finance's Jared Blickery standing by with a closer look at Bitcoin today. Jared?
Unfortunately, I don't have the best news here. Here's my crypto heat map. You can see Bitcoin, it's going to appear behind me, down about 5.74%. That's that big square to your left. Ethereum also down about 3.7%. Let me just show you what has happened this year. This is a year-to-date chart. I'm going to put some candlesticks. This was the big run-up into the spot Bitcoin ETF, so a much heralded moment, but it's been a bit sell the news ever since, and that was something we speculated could happen. And guess what? That's after we made new nominal highs. I'm going to put a 5-year chart on here, and you can see we just barely punched above. And this is something Bitcoin has done many, many times in the past. It breaks above in a false way or below potential resistance, support, and then it moves in the opposite direction. So is this a fake out? I'll tell you what, from this long-term chart, I'll put a 3-year chart on here. This simply looks like a bull flag, just a bit of correction before the resumption of the trend, which is up in this case. Not guaranteed, but that would be probably the best bet according to technicals and probabilities. Shana.
All right, Jared, thanks so much for breaking that down for us. Coming up, if TikTok ends up being sold, could Mr. Wonderful be the buyer? We're going to speak with Kevin O'Leary joining us here in studio right after the break.
If TikTok gets sold, it might have an interested buyer. Now that President Biden has signed the TikTok ban bill into law, the business and political worlds are looking to see what parent company ByteDance does next. But Kevin O'Leary, aka Mr. Wonderful, says he would buy the company, and he joins us now. All right, why do you want to buy this company?
7.2 million small businesses in America generating $11 billion of revenue.
Yeah.
That's why.
I mean, look, let's think about what the price tag on this would be. I mean, you are a famed investor. Everybody knows and could easily Google your net worth. But this is a high price tag. How do you go about financing something like this?
No one individual has enough to pull this deal off if you're getting a lot of the attributes that you want. If all you're getting is a mailing list and a tainted brand, called TikTok, that's not worth much. But I think what really matters is to understand who controls the deal. There's only one individual that matters right now. It's the supreme leader of China. Everybody else is irrelevant. Now, you have to ask yourself, what are his motivations? He could shut it down. He could say, look, we're just not going to sell it. Here's why he won't do that. There are many investors in ByteDance that are international and U.S. domestic investors. That whole value proposition goes to zero. So his cost of capital for financing China growth in the future is going to be much higher if he starts wiping out businesses that foreign investors invested in. So he's not going to do that. Then he has to decide, what do I want to sell? He doesn't want to sell the algorithm. That's widely known, so you're going to have to rewrite it. But we have precedent for this. When Skype was sold to Microsoft, they rewrote it in a matter of 6 months. We're going to have to do the same thing. But here's the real challenge. How do you keep those 7 million businesses that are generating all of that revenue on board during the choppy period of rewriting this algo? That's my secret sauce. Those are my people. Those are 2 generations of Shark Tank. That's what it is. They're all in their 20s and 30s. They're the Sharkies. That's what I call them. Here's my deal. I'm going to do the largest equity crowdfunding round in U.S. history, inviting all of them to come in right beside me as an equity shareholder. Right beside me. We'll start with the Jobs Act, but that's only good enough for $75 million. We need to file an S1, which I'll do. So if you want to be beside me at $500, $1,000, $250,000, you come in right beside me, and you are part of my team.
Are you talking about a SPAC here? Are you talking about...
No SPAC.
Okay, all right.
SPAC is a tainted word. This is straight private equity. You're coming in pre-IPO, but you're coming in at the terms I'm coming in at. Then I have to go, all roads on this deal lead to Abu Dhabi, and I'll tell you why. Many people don't know this, but over 300 TikTok employees are working in the UAE. The UAE is one of the most advanced countries on earth in AI. That's why Microsoft, if you think about it, basically put $1.5 billion in there last week. They invested $1.5 billion in G42. Mm-hmm. They did it because they know they're so advanced. I want to be partnered with the leadership of the UAE on this deal. We'll have US dollars too, but I need that nexus of AI to make this work.
Have you spoken to them? What has the feedback been like? And then also, you also need to get Washington on board too. So what have those conversations been
I've
like?
talked to everybody. First, I've been going back and forth on a shuttle basis to the UAE to Abu Dhabi, number one. I've spoken to Trump already. I've talked to Biden's right-hand people on this. I don't know who's going to win the White House. I need them signing the deal. This is the first deal in U.S. history that needs the pen of the president to approve it. I've also talked to Rubio. I've talked.
Are they on board?
Nobody's on board yet. We don't know what we're buying. Mm-hmm. I'm just saying I want to be at the head of this in terms of getting this thing organized. I'll talk to anybody I have to. I'm even proposing DoD oversight, background checks on everybody writing the algorithm, giving them full transparency and telling the American people that the supreme leader will not be spying on your children. And that's the right messaging because you want more advertisers. The best opportunity to build this platform is to get everybody on board that your solution is going to be totally transparent and compliant.
How much of a bidding war are you expecting? Because there were other companies years ago that threw their hat in the ring for purchasing TikTok.
Minutia more recently.
Right. Of course, lots of people, everybody can right now say, oh, I'm throwing my hat in the ring. Mm-hmm. But the capital required to make this happen is going to bet on the best solution. So I've got the Sharkies. I love my strategy for keeping them on board. And I think I've got the right metric in terms of how to rewrite this algorithm and putting a lot of it in a cooperative deal with the UAE and the US. That's how to make this work. And I think if you're sovereign wealth and you hear my plan versus the other alternatives, I think I'm going to win.
Kevin, what do you think the timing looks like on this?
Well, you've heard the CEO, this is a different topic here, basically say, look, TikTok's not going anywhere. I'm going to use the American court system to stymie the will of the American people in Congress and the pen of the president. How about this answer? No, you're not. Because we don't get the same right in China. I want reciprocal rights in China. I can't do this in China. I can't even set up TikTok there. I can't have spyware in China. And now that CEO is telling the American people and the president and Congress, I'm going to use your court system to stop this will, this desire, this law. How about no? You're not going to do that. That presses this deal forward. And the only person that matters, we go back to how we started this conversation, the supreme leader. What does he want to do? That's all I care about. Everybody else is irrelevant. If he decides he's going to wipe out the value here, his cost of capital on every investor worldwide goes up. That would be a mistake. That's why it's a game of chicken, but it's going to start happening fast. We've got 270 days, and the clock is ticking. Tick tock, tick tock.
It certainly is, and we appreciate you coming and making the time to join us here at Yahoo Finance. We hope to continue the conversation here as the clock does continue to tick down. All right, Kevin O'Leary, thanks so much. Great seeing you.
Thank you very much.
Let's get to another big story that we are watching. Amazon posting better than expected first quarter earnings after the closing bell last night. The tech giant catching a tailwind from its lucrative web services segment, AWS. Sales there spiking 17% from a year ago. The company is saying that Gen AI was the driving force behind that growth, but it does expect those spending on AI to be higher here for quarters to come. So what does all that mean for the company's bottom line? We want to bring in Brent Thill, Jefferies tech research analyst, here to break all of this down. Brent, it's great to see you again. We've talked to you time and time again over the last several weeks as to why Amazon is one of your top picks within this sector. So what did you think of last night's report?
They put up a really good mixed box of goods, as we put it in the Amazon world. When you opened it up, there were a lot of good things. You had AWS, which beat 17% growth. The street was looking for 15. You had the ad business up 24, which is a little bit better than the 23 the street was looking for. And then op income was up 37% ahead of the street. So Amazon works when you're in harvest mode, not when you're in invest mode. And they're harvesting a lot of the investments still from what happened through the COVID era and when they built out. So we were really encouraged by the discipline on the bottom line. We're encouraged by what's happening in the top line. If you want to poke holes, Europe wasn't as good as the US. The consumer was okay. The numbers were in line. They weren't off the charts amazing. So I think overall, even while they weren't great in Europe, their profitability in Europe was phenomenal. And they actually turned the corner and produced profitability in their international segment in the retail business, which was great to see. So the bears are going to point to, we're never going to see an AWS margin at 38% again. That was an anomaly in Q1. We're going to continue to see the guidance wasn't as good as everyone thought for Q2. So I think again not a blowout success, but certainly we felt very, very good about what we're seeing in the encouraging that AWS, again, that's half of the market cap in Amazon. The cloud business had a really, really good momentum and will continue to accelerate through the year as we're going to see AI now really start to spark the story on the AWS platform.
Yeah, Brent, I don't want to really poke holes. I actually want to nerd out about this advertising business that you mentioned a moment ago here. What type of growth rate do you think they can continue to see there? I mean, that's another high margin business for the company.
Yeah, the advertising business is in great shape, and they just started to bring Prime to Prime Video, advertising Prime Video. And that just started to happen. And so you're going to start to see is, when you start to go on and look for toothpaste or you look for anything online, they're going to be able to do sponsored ads that show up. Now what's going to happen is when you log in, you're effectively going to have, you may be interested in tennis, but I like golf. So you're going to see the tennis ads for all the new Wilson rackets. I'm going to see the new Titleist ads. So they're going to be able to gear advertisement to each of us, depending on what you like. And that's really powerful. And I think they're going to invest more into sports going forward. That's going to get more people to the platform. They're also going to invest, I think, in more daily content. If they do that, you're going to stop going from watching Prime once or twice a month to watching it hopefully every day. And if they do that and they can gear this advertising on video, there's a whole nother leg to their advertising opportunity that we haven't even seen yet that's going to filter into video. So we're really bullish about that opportunity. Again, it's a really high margin business. They already have the channels, they have the eyeballs, and you start to think about grocery. You know, if they add $10 a month unlimited grocery delivery, how many grocery companies are going to want to, fresh food companies are going to want to advertise on the platform? So we think there's still real opportunity. That is one of their fastest growing businesses at a high margin. And so that, again, in a great position. The two businesses we were really watching were AWS, the ad business, and then the operating income for the core retail business. All three, a little bit better, not a blowout, but just consistent, steady returns. And that's good. They pointed to no concern signals other than saying, Europe's a little weaker than the US. That's about it.
Brent, real quick on Amazon, and then we want to get your thoughts on Pinterest very quickly. But the weakness, though, in retail, I know you were saying you were closely watching the consumer side of the business, the retail side of the business. Any concern there, or the strength really that they're seeing in AWS, the ad business, enough to offset any of those concerns?
Yeah, we didn't get a lot of detail on that. I think right now, the retail side of the house, that was more in line. So I think everyone's watching what's going to happen to the state of the consumer. You saw the Starbucks numbers weren't great. You've seen some other retail numbers where you're starting to see a little bit of a fall off. We've talked to a lot of different consumer-based CEOs, and there's definitely a little underpinning softness in the consumer. Nothing too massive. But again, I think when you think about the bulk of the profitability, the bulk of the excitement are in these flagship cloud and advertising businesses. As long as those stay strong, and let's say the consumer gets a little weaker, they can offset some of that, and that's the beauty of the portfolio that Amazon has. And investors are going to valuing, half the market cap of Amazon is the AWS business. Yeah. So as long as that stays strong and they're going to accelerate, we see that. You see it in their backlog growth. Backlog up 41% in Q4, was up 20-something% in Q1. They're still, showing really, really good growth ahead of revenue. That revenue growth is going to accelerate. Mm-hmm. Who knows what the consumer is going to buy the next 4 months? I can't predict that, but this cloud business gives you great prediction, and that's why I think the stock's, rallying up today.
It sounds like those Titleist T100 irons, that might be on your purchase list for the next year here, Brent.
Got the T100Ss already, so I'm not good enough for the T100s. That's your kind of club.
I'm trying to hit them.
Humble brag there that you wanted to get in, Brad.
No.
Brent, let's talk. You were talking about some of the strength here within AI and within advertising business when it comes to Amazon. You can pretty much say the same when you take a look at Pinterest. Those numbers coming in better than expected. We're seeing a massive reaction in shares today. Can they keep this momentum going?
I'm not the lead analyst, but my partner who covers it, it's one of his favorite picks at Jefferies. So the underpinning opportunity of Pinterest, and again, I'm a user on the platform, and I think everyone has seen this where there's so much great content, but how do you actually transact? And solving that gap is such an incredible opportunity. If you could effectively buy the couch you're looking at for your house by looking at someone else's couch, and you like it how it looks in their house, and be able to do that seamlessly, that's a gold mine. And I think they can bridge that gap over time. So clearly the new management team's having a big impact. The platform's having a bigger impact. They're focused on profitability. And again, I think, the sentiment went pretty sour on a lot of these ad names in Q1, given some of the seasonality, but, continues to be, from my partner's perspective, who's the lead analyst, one of his favorite names for the year, and continue to recommend the stock here.
Brent Thill, Jefferies Tech Research Analyst. Brent, great to see you. Thanks so much for taking some time here this morning.
Thanks, guys.
Coming up, Starbucks, the brand of the green siren. Golden siren, what am I saying? Green siren. The shares are sinking following its first same-store sales decline since 2020. We'll speak with the company's CFO, Rachel. You see her there. She's going to be joining us next.
Starbucks shares are selling off this morning, off just about 15%, the worst intraday move that we have seen since 2020, following a surprise drop in same-store sales during the second quarter. Now, it's the first decline that we've seen there, also since the end of 2020. The beverage giant also continuing to grapple with slowing sales in China. Same-store sales in the region falling 11% from a year ago. Rachel Ruggieri, CFO of Starbucks, joining us now alongside Yahoo Finance's Brooke DePalma. Rachel, it's great to have you again this quarter. Thanks so much for taking the time to speak with us.
Thanks for having me.
Talk to us just about the weakness that you are seeing within the business and exactly what those turnaround plans or what you are hoping to see, how quickly that's going to take place.
So in the quarter, what we really saw was that our occasional customers, we started to see it softening faster than what we had expected. And frankly, we didn't respond fast enough. We had plans in place, and those plans didn't take hold in the way we would have expected. In addition to that, we have the continued headwinds in the Middle East, as well as a more cautious consumer environment in China and a high promotionary environment, which is pressuring the overall market. When we think about our plans, what we've done is we've stepped back, we've talked to customers. We know what our customers, particularly our occasional customers, are seeking is they're looking for more news, more often, a broader offering, coffee, non-coffee, food, healthier choices. And in addition to that, they're looking for value. Value isn't just about a price. Value is about product. It's about experience. It's about offerings. And our Starbucks Rewards customers, for example, they say very clearly they get value for what they get. But our occasional customers, particularly those who aren't in our program, don't see that value. So our greatest opportunity is to create greater awareness of the value that we offer for our occasional customers. So we're investing in and we've accelerated our technology around digital. We're opening the app for all. We're bringing more customers into the rewards program, and we're going to be demonstrating value on Mondays, for example. In a couple weeks, every Monday, there'll be app drops. It'll be very targeted, specific offers. So one person may have a pairing that's like a bagel and a coffee. Another person might have a 50% off as a way to be able to engage our customers more broadly, particularly across the occasional customer group. In addition to that, when we open the app, customers will be able to use a guest checkout to use MOP. MOP is incredibly popular with our customers. It was 29% of our sales in the U.S., which is up from 23% just a couple of years ago. It was 26% of our business in China. MOP really resonates as a great part of experience and convenience. In addition to that, we're strengthening our product offering. And we're having more news more often, broader offerings coupled with an integrated marketing approach so that we can create demand across the day parts largely in the afternoon.
And Rachel, do you think that right now the low-income consumer is still able to afford Starbucks? And with that being said, we ask you every quarter, but how much have menu prices increased from Q2 of last year to this year?
Yes. So our ticket this quarter was about 4%. That was a combination of annualized pricing. So even with the transaction headwinds that we saw, our ticket still held strong. So ticket was a 4% comp. It had about, I'd say the majority of it was annualized pricing. And then we had a mix shift towards cold beverages. So because of our successful promotion with lavender, we were able to increase ticket with the lavender offering. What that says is we have opportunity not only through traffic, but also to increase our ticket when we have the right offering for our customers. When we look at price, really what we believe is the best opportunity for us is value. And that's across the areas that I just spoke about. Customers, when they get that value and they have that experience, then they're willing to come to Starbucks. We see that with our very loyal customers, and we see that as our biggest opportunity with our occasional customers.
When you look across the regions that you're operating in right now, how much of the strategy needs to change, particularly in China, where we saw sales year over year decline double-digit percentage?
Yeah. In China, we feel very convicted about our strategy around continuing to strengthen our position in the premium market. There is a big increase in the mass market, and eventually there's going to be a tiering. And what's going to matter is resiliency. And we've built that resiliency in our business over 25 years in China. Store costs have come down by about 15%. New store costs have come down by about 30% as we've optimized across equipment innovation, across automation. That's helped to make make it so that our portfolio is profitable. And that's incredibly important. In addition to that, we're focused on continuing to lead in coffee and create relevant beverages while we're investing in our omnichannel experience. In the quarter, we grew our rewards members to a record 21 million members. And that was really driven by targeted offers, but it was also driven by the coffee offerings that we have, which has created a more routine nature in the business. In fact, we saw a breakfast day part was actually positive comp in the quarter. So we see a lot of opportunity to continue to strengthen the fundamentals of our business while we continue to create efficiency and resiliency in the overall business model, which is going to allow us to amplify our position when the business rebounds.
Rachel, in late 2022 and early 2023, you announced a major revamp of the Starbucks app. Do you think that this move by you guys pushed away consumers, perhaps? And how big will this new overhaul be? Could we go back to what we saw previously when it comes to freebies on the app?
I think what you will see is you will see more offers. And what's going to be good about those offers is they're far more targeted and personalized. We have accelerated our technology investments so that we could strengthen our offering. So, for example, on these Monday drops that I was talking about, I might have a different offer than you have, which drives a better return, but it also engages differently so that we can connect with customers and bring them along the experience. Our big opportunity is to increase downloads, increase registration, increase activation, and ensure that we're not seeing customers lapse. And so the offers will go across that continuum so that we can continue to strengthen overall the program, but also the value offering for our customers.
Rachel, we only have about 15 seconds here, but given the pushback that you saw this past quarter, are you thinking about cutting prices?
We are not. In fact, what we're looking at really is the value proposition. So we are investing. So there is going to be an investment to be able to drive that value, because when we bring customers into the program, we know that their lifetime value increases. They spend more money and they come more frequently. So we see that as our biggest opportunity, is bring more of the occasional customers in, even if they're leveraging the app in a guest checkout for MOP. It can increase frequency, it can increase ticket, but it also gives customers an opportunity to see what the value is that Starbucks offers.
Rachel Ruggieri, always great to speak with you. Thanks so much for joining us here this morning, CFO of Starbucks, and of course our thanks to Brooke DePalma as well. Well, coming up in the next hour, Madison Mills will be here with me for our new show, A Catalyst. We are going to be diving deeper into the biggest stories of the day. We're going to break down the latest job openings and labor turnover data. That's going to be released in just under a minute. Explore how recent employment trends could potentially impact the Fed's next rate decision. Plus, a slowing consumer. Food companies are seeing sluggish sales as lower income consumers pull back on spending. We're going to dive into what exactly this means for the broader economy. Stay tuned. You're watching Yahoo Finance. It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. It's our brand new show, Catalysts.
From equities to commodities, we're decoding trends and uncovering the drivers behind today's market moves.
Our team of experts are here to help you navigate all the possible outcomes to make the best decisions for your portfolio.
It's Wednesday, May 1st. Happy May. Let's dive into the catalyst moving the markets today.
Well, economic data revealing more stickiness in the Fed's fight against inflation ahead of today's Fed decision. Private payrolls coming in just above expectations, essentially in line. 192,000 jobs were added during the month of April. One bright spot, though, for the Fed, wage growth is seeing its slowest gain that we've seen since August of 2021.
And Amazon solidifying itself as a leader in AI, but its core e-commerce business could start to be in trouble here. The tech giant planning to spend big this year on infrastructure to support the growth we're seeing in AWS. Meanwhile, Amazon's sales forecast falling short of expectations as it sees a slowdown in e-commerce spending.
In the state of the consumer, reports from Starbucks, McDonald's, and Yum Brands showing that customers might be spending less or are spending less as prices continue to rise. The coffee chain seeing a surprise drop in same-store sales. Starbucks CEO is saying that customers are being a bit more picky with how they spend their money, clearly weighing on the stock today. Let's first get to some breaking news that we have, and the first is on employment data. March job openings coming in just below expectations, 8.5 million openings versus the 8.7 million that the street had been expecting. When you take a look at this number, the job opening rate was at 5.1%. That was versus 5.3% the prior month. Now, the pace of hiring is also something to note. That came in at 3.5% versus the 3.7% rate of the prior month here. So some of the readings there showing, I guess, obviously, the labor market remaining very tight, but some changes here when you compare it to the prior month. Layoffs and discharges, that was at 1% in March versus a 1.1% in February. So essentially in line with what we saw last month. I also want to bring up some of the ISM manufacturing data that we are getting out here this morning, and taking a look at that index coming in below expectations, just below expectations. When you take a look at that number, the estimate there was for 50. We saw that number coming in just below that. When you take a look at ISM manufacturing index falling to 49.2, the estimate was 50. ISM prices paid index, that, though, climbing to the highest level that we have seen since June of 2022. So let's take a look at the bond market, the reaction maybe that we are seeing in yields to this news. Not much of a reaction just yet. We have the yields still moving to the downside here, off just about 4 basis points. Maddie standing by with a closer look at the market's reaction. Maddie.
Yeah, it's interesting. I know this is a little tough to read when it comes to the intraday movement, but we were seeing that ahead of that ISM and JOLTS data drop, we did see the market starting to come off of its lows just a touch there, but now bouncing back up, still down though about 0.3% on the S&P 500. I also want to take a look at the Nasdaq, down close to 0.2%, but again popping off of its lows from earlier this morning as the market was kind of digesting ahead of the Fed data meeting that we're going to be getting later on today. I want to see though if I can pull up some of the individual names that we are seeing in the Nasdaq. So this is a really interesting picture to me because we are seeing that some of the heaviest names in the Nasdaq, your Magnificent Seven names, are all in the green except for Nvidia and Tesla here, but the market is still down. That indicates to me that we're seeing a broader sell-off as the market digests this data ahead of the Fed today.
All right, Maddie, we also have our very own Josh Schaefer standing by. And Josh, when you take a look, let's start with job openings here, because that fell 325,000 from the prior month. When you take a look at the quits rate, that was coming in at 2.1%. So give us just a better sense of how you think the street is reading this data and what this might potentially signal.
Yeah, I mean, I think the tick down on the quits rate's interesting, right? We've been at 2.2% since last December. Remember, this is data from March, so we're looking back pretty far here, but it coming in at 2.1%. The quits rate is normally viewed as sort of a confidence among workers, right? If the quits rate is going down, workers maybe feel less confident in the current labor situation because they don't want to quit their job because they don't think they're immediately going to get another one. It still is relatively in a range that we saw pre-pandemic, though, which I think is important to point out. A lot of economists have been flagging that at 2.2%, it was in sort of a healthy range. I don't think it moving down to 2.1% is necessarily a massive move. It did also come as hires ticked down, as you mentioned, to 3.5%. So the hiring rate now down at 3.5%. We're seeing that starting to come down as well. So I guess overall, if you just take this report in sum, some signs of softening, I guess, is sort of the read here.
Very tight.
Yeah,
market,
exactly.
Right? When you take a look at those numbers, at least when you compare it historically, like you were saying.
Absolutely, yeah. It's not like this is some flashing, I wouldn't even call it a yellow light. You know, like it's not a yellow light, it's not a red light, it's just a little bit of signs of softening, which if you think back to the story over the last year, a lot of people have been waiting for some signs of softening, and perhaps even the Fed wants a little bit of softening in this labor market.
How does this inform your thinking on that job stayers number in the ADP print that you were talking about earlier, that that's still at about 5%?
Yeah, I mean, so that was the job stayers wage growth, right? So wage growth is one of the things that people have sort of argued isn't really in the Fed's favor right now in terms of the inflation print. And I think we can maybe turn to that ISM report right now too, where we saw prices paid, as Shana just mentioned, hitting a reading of 60. That's the highest that we've seen since the summer of 2022. So I think the sum of the data that we've gotten in the last couple of days, including the employment cost index, which showed that hit its highest level in a year or two on a quarter-over-quarter basis, companies having to pay more for employees. When you take all of this into account, it sort of seems like it's just becoming a more challenging picture for the Fed in terms of inflation is at a point where it's a little bit stickier than people had hoped. It's not falling drastically. And Maddie, you call back to that 5% number from ADP this morning. If job stayers are in a wage growth range at 5%, economists argue that's simply too high. It needs to be more in a range of 2 to 4%. And so when you think about this data as a whole, and then you look at something like prices paid in the ISM being high, which can be some level of an inflation indicator, it's just not the best picture in terms of inflation falling as fast as many people hope, which I think will probably be a large part of the message that we hear later today.
Exactly, and always points to, or it has been pointing to, the exacerbating inflation concerns, something that has clearly plagued the market here when you take a look at the recent moves. And I mentioned that move that we're seeing in yields initially off the back of this manufacturing report. A lot of that having to do with that headline miss number. So coming in below expectations there, dropping back into a contraction below those expectations of what the street was looking for. And that's placing a bid on some of these on treasuries, and that's why we're seeing yields here under pressure off just about three basis points right now for the 10-year. All right, the latest decision on interest rates from the Fed is expected at 2 p.m. Eastern time today. The data showing that employment remaining strong, but inflation remaining stubbornly high when we take into account the ADP report that we're going to get that we got out this morning, also ISM manufacturing, and the latest results on JOLT. Chair Powell sounding, though, optimistic about that path to 2% inflation over the last couple of meetings. Let's listen to what he had to say back in March.
The story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. That of inflation moving down gradually on a sometimes bumpy road toward 2%. And we've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps?
Given another month of hotter than expected inflation readings, can we expect the Fed's narrative to change at all during today's press conference? We want to bring in Vincent Reinhardt, Dreyfus and Mellon, a chief economist, former Fed economist as well. Vincent, it's great to have you here. So summing up the recent data prints that we have been getting out, even what we are seeing this morning, what does that tell us just about where we are in the inflation narrative and what we're likely going to hear from Powell just in terms of how sticky prices remain?
What we're likely to hear from Chair Powell is bumpy, and the only question is how many different times will he say that word? Look, the last mile in reducing inflation to the Fed's 2% goal is hard. It's taking longer than they thought, but probably not longer than history would suggest. It takes a while for prices to get back into alignment when they were dislocated so much by the pandemic disruptions and the Fed's mistake in letting inflation get embedded into the system to begin with. Just going to take a while. This time round, we want to remember that the Fed's task is to recalibrate the level of the nominal interest rate to the decline in inflation we've already seen. So it's not another 10th here or another 10th there over the next few months. Inflation's a lot lower now than it was 6 months ago, 12 months ago, 18 months ago. What they're thinking about is what real interest rate, what nominal less inflation rate to set to prolong the expansion, which is kind of getting a little rough on the edges while making that last mile to 2%.
Well, given some of the data that we got in this morning, taking that into account, I'm curious what kind of pivot you think we'll hear from the Fed today from that December pivot away from their previous kind of hawkishness. We know that Jay Powell is likely to have to pivot away from that type of thinking. Do you think that we're going to get a full U-turn? Do you think we're going to get a slight shift away? How big of a pivot do you think we'll see?
The Federal Open Market Committee is a big old oil tanker. It doesn't make sharp turns. The pilot's got to send a signal for what to do in about 3/4 of a mile. So 2 things about what we'll hear this afternoon. The first is what we know already. They always lean into policy action at the previous meeting because they don't want to surprise us. So we know the funds rate is going to stay unchanged at 5.25%. We also know they're going to make an announcement with regard to the slowing of the runoff of the balance sheet because they warned us at the last meeting. They got very specific in the last set of minutes. So we know what the official communication of the FOMC is. Nothing on rates, slowing on the balance sheet. The interesting question is, how true to that storyline will Chair Powell be in his press conference? As you noted in the clip you showed, Chair Powell's a little more optimistic than the rest of his colleagues. He was really hoping that disinflation was going along a path that would let the committee ease in June. If they were going to ease in June, they have some work to do in this statement because they always warn us of it. They're not going to act in June, so they don't have to do any of that work. But he may leave it on the table. He may be a little bit more optimistic in his press conference. That's the open question.
Vincent, I'm curious just to get your perspective right now, especially when it comes to the consumer, because how do you square the falling confidence, consumer confidence, what we saw in yesterday's print, with the fact that consumer spending, at least overall, we're starting to see some cracks in the consumer, maybe this earnings season, but consumer spending has remained so resilient. What does that tell you?
Big disconnect between surveys and data. And it's not just households, it's firms too. I mean, look at the ISM this morning, but also look at consumer confidence, which is much weaker than you would expect relative to what they're spending at stores and given the unemployment rate and wage growth we've seen. So households and firms are not feeling good about themselves. And I think you suggested earlier on what that's about, and that's about inflation. The ISM, for instance, prices paid really over samples on oil and other commodity prices. They've firmed up. Firms feel the pain in price setting. Households just go to the grocery store, go to the gas station. They're not happy about their lot. And so it's importantly not made up. It's not an artifact of household and firms' mind. They're paying more than they used to, and a lot of relative prices are out of line. Goods prices are still much higher than the prices of the services they provide, and so they're not feeling good about themselves, and that's a problem going forward. And that's why the little softness around the edges in the JOLTS data, in the employment report, and in the surveys do suggest that the economy is slowing some, which means the Fed will ease. When are they going to ease? Not anytime soon, though.
Not anytime soon, but you're right. It does seem like we're starting to see that softness, particularly in a lot of the earnings prints here. Vincent, thank you so much for joining us as always. Really appreciate it. That was Vincent Reinhart, Dreyfus and Mellon chief economist and former Fed economist as well. We're now going to turn to the state of the consumer. Food companies, as we mentioned, beginning to show some cracks, particularly in lower income customers as price hikes starting to take their toll here. Yum Brands, Kraft Heinz, Starbucks, all the same story. Demand is weakening as the consumer becomes more choosy about where they're going to spend their money. Could this be a problem for the Fed moving forward? Joining us now is our very own Brian Sozzi. Brian, you've been on your streak of earnings CEO interviews. I'm sure you're exhausted, but talk to us about your main takeaways.
just want Jerome Powell to lower the cost of a KFC chicken bucket. We got more to say on the other side of the break. But really, I should note, this is really starting to become a major problem for a lot of companies, notably in the food space. Do they push through another round of price increases? In some cases, they've been doing this for the past 2.5 years. Or do they hold the line and see their profits start to come down? Now, we spoke to Starbucks CEO Rachel Ruggieri about the slowdown they, in fact, saw in their business because of the price increases they have taken. Here's what they had to say.
In the quarter, what we really saw was that our occasional customers, we started to see it softening faster than what we had expected. And frankly, we didn't respond fast enough. We had plans in place, and those plans didn't take hold in the way we would have expected.
And then you heard Starbucks there as well. Our Brooke DePalma continues to report, really digging into the reason for their sales slump. Now, I also put the same question to Mondelez CEO and Chairman and CEO Dirk Van de Put. Now, he is, in fact, seeing still high levels of inflation. I think Dirk is ready to push through even more price increases, but here's what he told us.
Frequency is a little bit off amongst the lower income consumer. And we also see sometimes the volume that they buy a little bit off. So we can detect that there is a group of consumers, particularly the lower income consumers in the US, that are being affected by everything they see, interest rates and the SNAP benefits that went away and so on.
Tie all this in a bow, it's that consumers continue to make a lot of choices. Does that occasional Starbucks shopper, do they need to go into a Starbucks and buy that second $8 coffee, or do they even need an $8 coffee in their life? I was searching KFC 12-piece chicken bucket prices this morning. A 12-piece meal for KFC delivered almost $40. And the size of the chicken has shrunk. I don't care what KFC says. I know that chicken has shrunk compared to when I was eating it in the mid-'80s as a kid. So you put all this together, I think people are looking for a lot of value. And then conversely, that's why earnings from Domino's and some of the other players that offer more value, Chipotle, those results have been good. You can go to Chipotle, get a giant bowl, $13, you get out. You go to Domino's, $6 pizza, feed your whole family.
Brendan, it's so interesting because I followed up with Rachel after she said that to us. And I was asking her more specifically about the pricing strategy. I was like, here you are, you have consumers clearly pushing back. Do you have plans to lower prices at all? And she said no. So if they don't adjust their pricing strategy, is this going to continue to be this case of this have and the have-nots, these outperformers who are offering these deals, getting consumers to spend through the doors versus those that are more so relying on this strategy that has not really been working over the last couple of years?
I think that's a play on words by Rachel. I mean, she's not going to say, hey, you drink, Shauna, you start your day with a venti. I know even though you drink off the food truck. I'm just going to blow it up there. But anyway, she's not going to say, hey, we're going to take that venti coffee down to $5 from $8. She's not going to say that. But what they are doing is going to offer more promotions via the app. So maybe just buy one drink, get one other one 25% off, or buy one drink, get more stars, come back next time. Because if they don't do it, this quarter for Starbucks is going to look as dreadful as the one they just reported. And that's just the reality. They have to start offering some form of discounts to get people through the door. And then I won't go too far into this, but the new products are horrible. I mean, the lavender latte is just not what it needs to be. And Starbucks talked at length about this on the earnings call. Now they're offering energy drinks. They're going to start selling a tomato mozzarella sandwich. Sounds like more inflationary items that Starbucks shouldn't be selling. I wish them luck.
Even you're not sold on the energy drinks?
If I want, I'm not sold. I don't go to Starbucks for an energy drink. I go there to get caffeine for coffee. If I wanted a mozzarella and pepper sandwich, I'll go to my local Italian restaurant. I mean, I'm just not getting that stuff at Starbucks because I know they're not making it fresh. They're taking it out of a kitchen. They're gonna wrap it in a package. You got to get me started. Or deli or something. I'm not going there for an energy drink and a roasted mozzarella sandwich. I'm sorry, guys.
All you want. You're not asking for much.
You had to get me going. It's all your fault.
Thanks so much for making the time, hopping on with us here this morning, breaking all of this down. All right, coming up, we're going to be talking a little bit more about Amazon. Amazon's big AI bets are paying off for now. You're looking at the stock reaction to earnings last night, up just about 3%. We are going to break down just how much this tech giant is planning to spend on AI, what it could mean for their bottom line next.
Let's do a check of the markets here, sponsored by Tasty Trade. Looking like some more red on your screen. The S&P 500 down 0.3%. The Nasdaq rounding up to a downside of 0.3% here as well. The Dow, the only major index in the green as of this morning here. Just taking a look at some of the lowest performers, CVS and SMCI and Starbucks, the three biggest laggards in the S&P 500, dragging down the entire index this morning, especially as the overall index and investors await that big Fed meeting coming up later this afternoon. A lot of big news on our plates today. Well, in the race for AI dominance, Amazon is making headway. The company's earnings and sales topping estimates as artificial intelligence did boost the company's cloud computing growth. Now, this comes after Meta, Alphabet, and Microsoft also announced increased AI spend. For more on the overall picture of AI spend driving gains for these big tech firms, we have our very own tech editor, Dan Howley. Dan.
That's right, Maddie. We have the message from Wall Street is clear. Spending isn't changing anytime soon. Big tech companies are planning to spend hundreds of billions of dollars over the next 2 years as they race to be the leaders in next-gen artificial intelligence technologies. And like its competitors, Microsoft and Alphabet, Amazon is also throwing cash at its AI efforts. And it's paying off. While the company said it's still early days, it reported that its generative AI business helped push AWS's growth rate higher, hitting an annual run rate of $100 billion. And according to CFO Brian Olsavsky, customers signing up for longer deals with bigger commitments for generative AI and non-generative AI workloads. The company reported spending $14 billion on CapEx in the quarter and said that that will be the low for the year, and it expects to blow past the $48.4 billion it spent in 2023. Now, Amazon's report comes a week after Microsoft announced better than expected earnings powered by its Azure cloud business. Google also saw better than expected earnings amid AI growth, but investors seem to be most interested in the company's new 20-cent per share dividend. While Microsoft had an early lead in the AI race, it's clear that neither Amazon or Google are giving up.
All right, Dan, thanks so much for breaking that down for us. Well, Amazon's generative AI investments, they do seem to be paying off, at least for now. AWS CEO reiterating on the company's earnings call that AI spending is fueling cloud computing growth as the firm confirms that it is on track to earn $100 billion in annual revenue this year. The number is not, though, as staggering for Amazon's consumer business, but does that matter given their success elsewhere? Joining us now to break it all down is Christopher Jonan, a global platforms and internet services analyst at HSBC. It's great to have you here. So talk to us just about this quarter. When you see impressive growth or the growth returning here, accelerating in AWS, what does that tell us just about Amazon's ability to compete with who is viewed as the AI winners, at least up until now, when it comes to Google and to Microsoft?
Yeah, I think it's obviously very important. They spend a lot of time talking about what they've been doing and what they are going to do. I mean, if you look a little bit back into the history, right? Amazon has never been new to the AI game, really. If you look back, I think it was probably in 2015 or 16 when they started investing in their own proprietary silicon. So they've been doing this for a while. I think they had a bit of an issue selling to investors how I would say in comparison to the Microsoft OpenAI deal, it wasn't. They haven't been as flashy, as public, with their AI initiatives. But I think actually, the current offering seems to be getting decent traction with customers, at least. That's what the company has been suggesting. And as far as the CapEx is concerned, I think we're probably going to see more of that in the quarters to come. I think investors probably aren't as shocked about what they heard yesterday, given that Amazon is the last one to report, and all the others have basically been hinting at that. So, yeah.
Well, it's interesting in your note, you spell it out really clearly. You talk about how there's been years of this outsized investment from Amazon, and now they're harvesting the fruit of that investment. Talk to me about what that shift and payoff looks like to you. How do we know when a company that's pouring a lot of capital into AI is starting to really see that payoff? What do you look at for that?
I think the comment about them being in sort of a harvesting phase it's a general comment for them. If you look back over the years, they've had a number of years where they've been heavily investing into all kinds of areas, whether it's e-commerce or AWS or, related products. And there have been, a couple of years then, sometimes 4 or 5, where they've been really letting investors take a look under the hood. I'd say how good the underlying mode of the business really is. And yesterday, they were actually asked about whether the pendulum is potentially going to swing back from, let's say, the better profitability that they've shown, particularly in the last 2 quarters, back to strong investment. And said, look, we are now in a phase, or we're now actually at a size where we are big enough to do both. Ensure proper profitability and actually keep investing. And I think that's what's really important and was probably changed in particular in the past 2 quarters for them. So AI, harvesting the fruits just on the AI side is probably still a little bit too early to really, let's say, put a check on that. But overall, the harvesting theme seems to be quite prevalent in the numbers.
So, Christopher, square that then with the greater short-term caution that we are seeing from shoppers, those who are trading down because of prices. Does that derail that more optimistic viewpoint at all?
I honestly don't think so. This is I would say, if I had sort of a pecking order of things that I consider to be most important for the Amazon investment case, the e-commerce business is probably not first.
Oh, we might have actually.
Particularly in the past 5 or 6 quarters. Sorry about that. So in the past couple of quarters, the market was most worried about growth decelerating in AWS. So what we saw yesterday, them beating by around 200 basis points, is probably by far the most important thing, and that they have made good on the promise that we've seen the trough in terms of the growth rate at AWS, and I think that far outshines the a bit more cautious consumer outlook. Yes, they said consumers are trading down in parts and somewhat more price conscious, but I think that is not the most important part for the investment case.
All right, Christopher Jonan, we have to leave it there again. Amazon shares moving to the upside here in early trading, up nearly 3%. Christopher Jonan, global platforms and internet services analyst at HSBC. Thanks so much for joining us here. Let's take a look at shares of New York Community Bancorp. They are soaring today. Look at that, up just about 25%. The troubled regional lender reporting a loss of $327 million in the first quarter. That, though, was narrower than expected. The stock also moving higher after its new CEO outlined a, quote, clear path to profitability over the following 2 years. And Maddie, we're seeing such a reaction in the stock given what has taken place over the last several months. There were a lot of concerns about New York Community Bancorp, this regional lender specifically, and the exposure that this company has to commercial real estate, exactly what's going on, especially right here in New York City. So there was some concern about that, some potential losses here down the road. That hammered the stock over the last several months. We have seen executive changes. We have seen a new leadership here take control of the company, lay out this new transition plan for New York Community Bancorp and the quarters to come. And at least it looks like investors are on board with the improvement that they've seen so far, and also are very encouraged by some of the guidance and some of the projections that were laid out by the new CEO.
Absolutely. And it's important to note, too, in terms of the stock itself and the context there, the stock has fallen more than 70% since the beginning of this year, but up more than 20% as of this morning. You can see still in the green here. But the reason that we look at New York Community Bank is because not only does this give us insight into the regional banking sector as a whole, obviously having a lot of volatility in that space following the banking crisis in March of 2023, but also this is one of the 30 biggest banks in the country. They have $112 billion in assets. So what goes on with NYCB could be an indicator of what's going to come for some of those other big regional banks as well. But we're also looking at the travel sector this morning. Norwegian shares in the red today. The cruise operator missing the street's revenue expectations and announcing softer guidance for the full year. That is despite growing demand for domestic travel. Also seeing shares of Marriott moving to the downside. The hotel giant reporting flat domestic demand for the quarter. Now, what's interesting to me about both of these names is that I'm seeing some analyst commentary about valuations for both companies, particularly Marriott, with analysts at Citi pointing out the valuations are at their highs. So there's a question to be had about whether or not there's any more room to run there. Also, Citi citing the macro picture of the consumer that we've been talking about so much and how that could start to weigh on consumer spending for some of these experiences.
Yeah, and I think you're exactly right there, Mandy. Also, the slowing U.S. growth could be a pain point here for Marriott going forward. Jeffrey's out, saying things that along the same lines, it sounds like, as Citi, because they did highlight the surrounding economic momentum and some of the concerns laid out there and exactly what that could mean for Marriott here going forward. So there are some reasons to at least take issue with this print here for Marriott. And I think you can say the same or very similar story when it comes to Norwegian. When you take a look at that stock reaction, we're taking a look at a one-year chart, but even the right-hand side of this chart, the climb that we have seen in shares since the start of the year, it was almost priced to perfection, and they needed to hit it out of the park on every single metric, it seems like, in order to please the street. So we're seeing a huge reaction, negative reaction to shares here. When you take a look at actually what they reported, demand was strong, pricing power remains. We saw that tick up here during the most recent quarter. The guidance was raised. They did beat on earnings. They had record bookings during the quarter, yet we are seeing the stock punish just about 10%. And it wasn't quite perfect because it did miss on revenue. So the fact that it did fall short just a little bit there, we're certainly seeing that way on the stock today.
Absolutely, seeing that in the red for sure. Well, coming up, we're going to take a look at private payroll data and what that means for the economy and rate cuts or rate hikes for this year. That great debate continuing as always, the FOMC meeting kicking off here and wrapping up actually today. We're going to look ahead to what you might expect. That's coming up after the break. Well, 192,000 jobs were added in the private sector last month. That's according to the ADP report. And we also had an upward revision for the month of March. And this comes ahead of the jobs report out on Friday, with the Bureau of Labor Statistics estimating 240,000 jobs added in that upcoming print. To break down what the ADP report means for the broader economy and what the jobs market is looking like right now, we have Neela Richardson, ADP chief economist, here with us. Neela, thank you so much for being here. I got some information from our reporter Josh Schaefer, who was on the media call with you this morning. He says that while everyone is talking about what inning the Fed is in, you prefer to look at what yoga pose the Fed is in. So talk to me about what that pose is and just how long they'll be able to hold on for.
Hi. Thank you for that question. I think it sets this up really nicely. I think it's a tree pose, and here's why. It looks deceptively simple, holding that pose. It looks like you're just standing on one leg, basically. But the longer you hold it, the more difficult it is. And eventually those muscles start to tense up, they start to shake. And I think that's what we're seeing from the Fed right now. Yes, they have some ability to be patient and keep rates where they are right now and still hopefully see inflation start trickling back down to that 2% target. But the longer they hold it, the more pressure they're getting from consumers, the more pressure they're getting from Wall Street, the harder it is to maintain the position. So it's a difficult situation to be in, even though the Fed can be patient when it looks at the economy, when it looks at the demands from consumers and Wall Street, the position is getting more and more tricky.
How much of that is because of wage gains, do you think, up until this point? And at least with the report that you put out this morning, a 5% gain in wages was actually the smallest that we've seen since August of 2021. So is that upside pressure there maybe starting to ease a bit?
Yeah, pay growth has come down. It's come down a lot, and we are able to match individuals with themselves. So these are not cohort effects. It doesn't matter what industry was hiring. We are measuring Sally's pay this year versus Sally's pay over the last 12 months, and it gives us a very vigorous sense of what pay growth is doing. And that 5% is low, but we've seen it start to plateau. It's very similar to what the pay growth was in March. We're not seeing those steady step down declines. And it reminds me of where we were in the first half of 2023 when pay growth moved sideways for a period of months. Is that a return given the strong hiring that we're not going to see the same type of deceleration on pay that we've experienced over the last 6 months?
I keep wondering, Neela, whether or not the Fed ever has to necessarily care about this bifurcation that we're seeing. It's not necessarily part of their dual mandate, but at what point could that bifurcation in higher income consumers continuing to do better and better start to weigh on our economy in a way that could be significant for the Fed?
You know, I think the Fed cares a lot about the distribution of their policy effects. I think they care about whether savers versus investors are able to take advantage of whatever interest rate position. Remember, when we were at rock bottom rates, savers, and a lot of them are retirees, weren't benefiting in terms of their savings rates in their bank accounts. And so I think they care a lot about it. And it also justified for a long time leading into the pandemic, keeping rates so low because they were starting to see pay growth at the bottom end of the pay distribution, and they cheered that. Now, if we fast forward to after the pandemic and 3 years post this recovery, what you're seeing is that, yes, low income, low pay workers have been doing great when it comes to the rate, but not so great when it comes to the level. So their pay is still not quite keeping up with the higher price levels that we've seen that was just detailed. It's close to lunch in a really great way. They're seeing all the prices go up when it comes to rent and food and gas. And so pay growth is not meaning and translating the same on Main Street as it is in terms of our big picture monetary policy.
All right, Neela Richardson, ADP chief economist, thanks so much for making the time to talk with us here this morning. Well, the Fed decision, like we've been talking about on rates, is just hours away. Now, the main focus, and really what we have been talking about over the last several weeks, are rate cut expectations. And at least from the big banks, they have been declining since the start of the year. Well, our next guest says that actually what might be the catalyst here for the market is whether or not the Fed tamps down fears of rate hikes. So for more on this, we want to bring in Krishna Mamani, Lafayette College, a chief investment officer. Krishna, it's great to have you here on set. Thanks so much for joining us.
Thank you. Happy Fed Day.
Happy Fed Day. All right, so let's talk about what we're going to hear from Powell, because I think the conversation has maybe started to shift over the last week or so. We've been getting more and more chatter about a potential rate hike. What do you think we're going to hear from Powell today?
So I think if you go back to the last meeting, despite the fact that they had marked up their growth expectations, he insisted that we are still talking about cuts, and they actually had cuts in their report. The challenge this time around is that they don't have the data to kind of let them continue with that theme. So in the presser, what he's going to get asked is, well, are you going to raise rates? And last time someone asked a Fed member, they said, yeah, we may raise rates. I don't think they would be that cavalier this time around. I think nobody is more aware of lags and things like that and impact on the economy than the Fed. So I think if their goal is still to continue down this path of keeping tight policy, but kind of keeping their eye on the fact that if they get a recession, it'll be hell to pay for a lot of people, and somehow find a way of keeping the growth alive. I think what they have to do, and what they should do perhaps, is tamp down the expectations of further rate hikes. If they do that, I think that'll probably have a positive reaction in the marketplace, because one, we have sold off some, and second, the expectation of no rate increase further. When you cut off that tail, that in itself is reasonably okay for the markets.
But there's been so much resilience in this economy. Part of me wonders whether or not the market would even care if the Fed did decide to keep rates higher and even hike, because we've had such resilience.
Well, I think if they go out and say that, yeah, we will raise rates if the data says that in a blanket fashion, I don't think the markets will take that very well. I think that opens up a rate path that I think we haven't had in play for almost a year and a half.
But does the market sell-off that would induce, is that good news for Jay Powell? Do they like the idea of that happening?
Well, so I think at the margin, from a growth perspective, that will probably help a tad. But what they are also concerned about is that sets up forward guidance that they will probably have to walk back if you see any significant slowdown. And I think the difference between 5.25, 5.5, and 5 3/4 is really not that substantial, unless they want to open it up in a big way that it's more open-ended, 6, 7%, whatever. And I don't think we are at that level, given the trend that we have seen in inflation. And as long as that is the case, their purpose is served by capping things out rather than opening up a path that creates all sorts of risks for the markets. And especially given the size of Treasury issuance, I think the impact on the long end of the market of something like that would be a big disaster for the Fed.
Christian, let's talk about the path, what you were just talking about here for inflation. We had seen some improvement that looks to be leveling off, at least for now. That path forward, do you think we're going to continue to trend sideways now for some time before we see maybe some more substantial improvement?
I think that's what it is looking like right now. If you look at, I expected beginning of the year that things would continue down the softening path, but that certainly hasn't materialized in any significant way. Every data print that you have gotten over the last 4 months has been a strong data print, and there's a reason to kind of question your priors as to what is the underlying thing that is driving it. And the underlying thing that is driving it is that the fiscal deficit is still working through the system. So I think expecting significant slowdown in the near term is probably not the right thought from in my perspective. But I think thinking that it would be so strong that the Fed would kind of contemplate raising rates further is probably a bigger stretch in my judgment.
So you don't anticipate a market slowdown. Do you anticipate any economic slowdown that would near recession territory for this year?
Oh, no. I think given the trend in data, expecting recession in 2024, I think it's an unrealistic expectation. 2025, if things continue continue the path that we have, even early part of 2025, I think it's questionable if we see significant slowdown.
Mm-hmm. All right. Well, Christian, we're going to have to leave it there, but thank you so much for joining us. We really appreciate it. Thank you so much. Christian Mamani, Lafayette College Chief Investment Officer, joining us on All Things Fed. Well, coming up, the DEA is proposing reclassifying marijuana from a Schedule I narcotic to Schedule III. We have the CEO of Curaleaf to discuss what this could mean for the future of the cannabis industry. We're going to be back with that conversation after the break. The DEA is proposing reclassifying marijuana from a Schedule 1 narcotic to Schedule 3. Schedule 1 narcotics include heroin, cocaine, and ecstasy, while Schedule 3 narcotics include the likes of ketamine, steroids, and testosterone. 38 states already have medical marijuana laws on the books, and 24 have legalized recreational use. So this could be a potential major shift in federal policy that could then have an impact on the overall cannabis industry. And we've certainly been seeing that off of this news when it comes to cannabis stocks. So for more on this, we have Matt Darren, Curaleaf's CEO. Matt, thank you so much for being here with us to talk about this news. Obviously, this is far from finalized, and it does not mean that marijuana is federally legalized. But talk to me about the likelihood of this having an impact. I know you were on with us 7 months ago when the Department of Health and Human Services recommended this. This feels like a story that's been going on and on and on and on. How likely is this to actually become a reality?
So it has been quite a journey, and thanks for having me back on. It's been quite the process that the government's been going through, starting with the HHS recommendation 7 months ago, as you mentioned, and now culminating with the DEA's recommendation to follow through on the Schedule 3 recommendation. So it is really a historic moment, I would say, for the industry. It's a long time coming, but I think the findings are really backed in science and backed on the very detailed review that the government did to evaluate the medicinal benefits of cannabis, and that it truly does belong as a Schedule 3 substance versus Schedule 1 on par with things like heroin and fentanyl, which all Americans have known for quite some time just was not right.
Yeah, Matt, when we talk about the business implications, exactly what it means here potentially to your bottom line, we're talking about some additional adjustments here, removing some taxes. So clearly that would benefit you and your rivals here, at least over the longer term. My question to you is, does this make it easier, do you think, for lawmakers then to be on board and pass safer banking? Because that's a critical issue here.
So any step forward here, I think, certainly helps in the normalization of cannabis and demonstrates to legislators that there is widespread support for it. So while this is certainly a different process, the rescheduling versus safer banking and other legislative actions, I think it absolutely sends a signal to those in DC that there is widespread support for this, that the federal government acknowledges that there is medicinal benefit to cannabis, and that ultimately this belongs regulated similar to other industries. And so I think it certainly will help from that degree, but it's a separate process, and working through Congress has its own complexities.
Is it going to bring on institutional investment, just removing that layer? Talk about the classification.
We do expect that. I think, the removal of 280E, this punitive tax rate that has cannabis companies paying up to an 80% effective tax rate. No other industry in America is subject to this type of punitive tax rate. As an example, for Curaleaf alone, we're paying in excess of $150 million of 280E taxes, to the federal government. So freeing up that cash flow to be able to reinvest in expansion, in personnel, in new business development, I think is getting the attention of institutional investors, and is going to continue to attract interest. And I think some of the plumbing that has really held back institutional investors from being able to participate in the market due to custody and listing exchanges, this is another incremental step, I think, to get institutions more comfortable with now investing in cannabis.
Matt, I have 2 quick points from our audience of retail investors on the Yahoo Finance platform that have commented with some questions for Curaleaf specifically. One of them wondering whether or not your guidance for financials is going to change off of this news. Do you have an update on that?
So we have an earnings call next week, and we'll be speaking to all of the exciting new developments here. So I'm not going to speak to that today, but we have an earnings call next Thursday. We'll be speaking to it.
All right. Well, hopefully we're going to be able to have a chance to follow on that with you. But also, I wonder whether or not there's any potential of a merger in your future. A lot of comments on whether or not Tilray and Curaleaf would have a potential for future relationship. I know you won't talk about that specifically and break that news with us, but any thoughts on a merger in your future?
So we've been really focused on our core business and continuing to invest both in the U.S. and internationally, as has been reported. We continue to really focus on the international business, with expansion into a number of different markets throughout Europe. So I think we will continue to be opportunistic as we look at expansion opportunities. And I do think the rescheduling will open up the markets, and you will see in general more M&A activity begin to pick up, which has really been quiet the last period of time due to challenges in the capital markets. So overall, I would expect to see more activity coming up, and we're certainly always evaluating opportunities to increase shareholder value and to continue to grow the business.
All right, Matt, Darren, we have to leave the conversation there. We look forward to hopefully having you back on Yahoo Finance again soon. CEO of Curaleaf. Thanks so much, Matt.
Thank you.
Let's do a final check of the markets here. You're still looking at pressure, at least for the S&P and the Nasdaq. The Nasdaq trading just below the flat line. You've got the Dow up 98.
And we're going to have our Brad Smith taking over for Wealth in the next hour, exploring a brand new survey about how small business owners are feeling ahead of the presidential election. We'll be back tomorrow. Thanks for joining us.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, Biden forgives another $6 billion in student debt. We'll tell you if you qualify. And combating the rising costs of auto insurance. We get the tips and the tricks from an expert on that front. Plus, a new survey reveals the small business vote is still up for grabs in the 2024 election, perhaps. We'll discuss the key issues for these voters. That and much more on today's episode of Wealth. But first, let's do a quick check of the markets. 90 minutes into the trading day, stocks are mixed right now ahead of the Fed's third decision on interest rates this year. The central bank is expected to leave the Fed funds rate at its current level of 5.25% up to 5.5%. That's the range. With optimism for rate cuts fading, borrowers and savers need to be prepared for all types of scenarios. For more on what's the Fed's policy decision meaning for you and your money, we've got Yahoo Finance's Jennifer Schonberger. Hey, Jen.
Good morning, Brad. The Fed widely expected to hold interest rates steady this afternoon in the face of higher than expected inflation data in the first quarter. Fed Chair Jay Powell likely to double down on his message from 2 weeks ago when he said that given recent inflation data, it's likely to take longer than expected to achieve confidence inflation is falling back down to the Fed's 2% target. Translation, rates are likely to be held higher for longer. Wall Street certainly getting that message, now pricing in just one rate cut this year. That's down from 3, the number that Fed officials themselves had penciled in back in March before that hotter inflation data came in. So what does this mean for you? Well, first off, higher for longer means that mortgage rates, which have topped 7%, are likely to remain high for some time to come. Interest rates on credit cards and other loans will also remain higher. Higher rates could also be a headwind for stocks, since stocks are valued using Treasury yields, which are treading around their highs of the year. On the flip side, savers will benefit from earning higher interest on their savings. Now, if the job market deteriorates, then Powell signaled the Fed could cut rates, something that could offer borrowers relief. Though if that happens, then the economy and the job market could be in trouble. The longer the Fed holds rates at current levels, the chances for a recession increase. We will get insight for just how the Fed is thinking about cutting interest rates now when we hear from Fed Chair Jay Powell during his press conference at 2:30 this afternoon. Brad?
All right, Jennifer, thanks so much. We're all going to be staying tuned for that decision and the press conference as well. We appreciate you teeing that up for us. Another story that we're watching here today. Amazon, the tech giant, impressing Wall Street with its earnings. Shares are up right now by about 2.3% on strong results driven by growth in its cloud computing unit and its advertising business, two of those high margin businesses for the company. But with the company continuing to spend big on artificial intelligence, is Amazon's e-commerce business at stake here? For more on this, let's bring in Mark Schmolik, who is the Bernstein Internet Equity Research Analyst. Great to speak with you as always, Mark. Let's just dive into this. I want to get your read on this earnings report and what it pertains to the consumer as well here.
Yeah, thanks, Brad. Look, I thought it was a great report. You know, top was strong on the consumer business side, also on the AWS side. Margins were incredibly strong as well. And, you know, I think there was some nitpicks, certainly. And one of them is revenue guidance for the second quarter maybe looked a little bit soft. Now, I think there is some FX in there. You know, we have heard from Jassy that, you know, there is maybe a little bit of squishiness with the consumer that they're certainly watching and paying attention to. But at the moment, things do look like they're tracking quite well, and perhaps there's just some conservatism built in.
Okay, so all of these things considered, as we're thinking about the elements of this business that are mattering most for Amazon investors to continue to watch going forward, it seems like there's going to be some more spending as it pertains to generative AI demand that they're seeing that dovetails into the AWS part of the business. High margin business allows them to invest in other parts of their business as well here in segments. And so where should we be monitoring some of that CapEx?
Yeah, I think, you know, they said they spent about $14 billion and expect that to increase meaningfully each quarter as we go throughout the year. Now, there's one nuance, right? As we think about investors and their biggest worry about owning Amazon here, it was a very crowded name, you know, has been about, are we going to go enter in another investment cycle? And we've certainly heard it from, you know, some of the other big tech names that we are going through this AI investment cycle. And so there's a fear that profits would diminish. What we heard from Amazon, though, was they could do both at the same time. They could continue to drive margins from their core business and use those incremental profits to invest in AI. That's a very specific nuance we haven't really heard from the company before, but they're certainly going to participate in this AI investment cycle. But it also sounds like they're going to continue to drive profitability elsewhere in the business.
April was a rough month for stocks here, and Amazon, they also got a fair bit of that as well, but not as much compared to the broader markets here. What does that tell you about the strength of this Amazon trade at this juncture?
Yeah, I think when the dust settles on earnings, Amazon's going to emerge as kind of the cleaner name amongst the Mag 7, in terms of where investors should be focused on. And part of that is because there's a lot of narrative, there's a lot of noise, there's a lot of question marks around where do we go with digital advertising, where do we go with AI? And I think what you'll see with Amazon is that they're in core businesses that are firing at all cylinders. Retail margins look incredibly robust. AWS is growing, so we've got that secular cloud growth story with 38% margins. That's probably not sustainable, but it speaks to the leverage in the business. And advertising is keeping pace with the really strong recovery in the digital ad market.
There are a lot of, and especially for our show focused on wealth building and of course growing wealth as well, there are a lot of small businesses that look to build their wealth via platforms like Amazon's, like Timu's even. Where is that kind of continuing to either strengthen the relationship or based on what Amazon's prioritizing, how should those small business owners be navigating their ability to build their own type of presence and profile on Amazon in this near term?
Yeah, certainly. If you're a small retailer or a small merchant, Amazon is still the best place to grow and scale your business. You certainly hear a lot of excitement around a Temu, if you're a Chinese-based supplier, or a TikTok shops, they certainly get a lot of attention. But Amazon shared that something like 60% of products are being delivered now in the US same day or one day, and that delights the consumer. And so if you want to go in a place that's going to get 60% of product searches where consumers begin and are effectively delighted by how quickly they get those products, Amazon's going to get you that distribution. And if you're a business that's just looking to build and get your infrastructure set up, I still believe Amazon's got the best, self-serve capabilities on the AWS front to get you up and running.
Mark, thanks so much for taking the time. As always, great to see you. Mark Shmulik, who is the Bernstein Internet Equity Research Analyst. Appreciate it.
Thanks, Brad.
Thanks. Well, let's go to the brand of the green siren here. Starbucks shares are under pressure as consumers pull back across the globe. The company saw sales decline in the U.S. and in its international markets, especially in China. Here to discuss what this could mean for the price of your latte or that unicorn frap, senior reporter Brooke DePalma here. Hey, Brooke.
Yeah, good morning, Brad. This really gave us an inside look at the state of the consumer. We saw declining sales across the board, not only here in the U.S., but in those international markets and even in China, as consumers really pulled back on just how frequently they went to Starbucks and also how much they spent while they were at Starbucks buying their latte, or maybe not buying that side of food like we saw a few years ago. And this morning, we all spoke to Starbucks CFO Rachel Ruggieri and asked if there was plans to lower prices. Here's what she had to say.
We are not. In fact, what we're looking at really is the value proposition. So we are investing. So there is going to be an investment to be able to drive that value, because when we bring customers into the program, we know that their lifetime value increases. They spend more money and they come more frequently. So we see that as our biggest opportunity, is bring more of the occasional customers in.
And that occasional customer is really what they're missing here. They're missing that person who maybe doesn't go as frequently, but comes in, spends a lot of money, and then maybe comes back again soon. And so they're opening up the app to guest checkout come this summer, where consumers can really get an inside look at the value that they have, and then hopefully in turn become a loyalty member. But consumers spending less per ticket. They're not adding as much food. They're not adding maybe those caramel syrups. And right now, it's getting a bit more expensive than it was a year ago.
Yeah, absolutely. And trying to think through exactly where some of those interactions actually showcase value that they're talking about. And the value that Starbucks talks about is perhaps different than the monetary value that a lot of consumers think about as well here.
Right. What Rachel was telling us is that it's the experience, it's the allure of Starbucks. Yeah. It's getting that sweet cream cold foam on top of your cold brew that they really want to weigh in to make it seem or make consumers think that they're getting the best bang for their buck for this really experiential opportunity with their morning coffee. And for example, when you take a look at just how much a game this is growing to be, when you take a look at Starbucks, McDonald's, and Dunkin', this morning, going to Starbucks, grabbing an iced cafe latte here in New York.
Was this your order?
This is my order. This is my order here.
Okay.
Here in New York for a regular latte with caramel syrup, that's going to cost me here in New York City, once again, again, about $6.45 and about $7 with tax. But if I was to go to Dunkin', it would only be about $6. And if I was to go to McDonald's, which is ramping up its coffee game, we've seen in the recent year, that'll only be about $4. And so we're seeing about a $3 discrepancy between the price of coffee at McDonald's versus the price of coffee at Starbucks. And now McDonald's knows that it has the opportunity to gain some of these customers who are thinking twice about where they're going to get their cup of morning coffee. Is it at home? Is it at McDonald's? Or are they going to lean into this experience, this value that Starbucks hopes to bring?
Could come back to the rewards potentially as well here. Brooke DePalma, thanks so much for breaking this down for us. All things Starbucks. All right, guys, turning to the world of healthcare. The CEO of UnitedHealth Group, Andrew Whitty, facing a grilling in Congress over the massive cyber attack on Change Healthcare back in February. The attack crushed the U.S. healthcare system, and the effects are still being felt today.
As a result of this malicious cyber attack, patients and providers have experienced disruptions, and people are worried about their private health data. To all those impacted, let me be very clear. I'm deeply, deeply sorry. The decision to pay a ransom was mine. This was one of the hardest decisions I've ever had to make, and I wouldn't wish it on anyone.
And backing into some context here, UnitedHealth, among the top 20 companies by market cap globally, acquired Change Healthcare back in 2022. Now, Change Healthcare is a revenue and payments company that connects providers and patients. UnitedHealth was forced to shut down Change Healthcare after hackers gained access to personally identifiable information. The stoppage, it caused widespread disruptions for providers who relied on the platform to submit claims. Patients experienced delays in care here, and the attack cost UnitedHealth only $870 million in the first quarter, and the full costs are yet to be known here. Here with more, we've got Yahoo Finance's healthcare reporter, Anjali Khemlani. I mean, we say only $870 million, but I mean, it could be more, and that's still a hefty cost.
It is. Looking at the market cap, as you just pointed out, and also looking at the fact that it was a $100 billion company just in the first quarter alone, that is a drop in the bucket for the company. Change is actually about 2% of the company's revenue, so not a really big driver for profits there. But what it is a brand bust for the company, and that's really where the pain comes from. The company initially insisted that no personally identifiable information was hacked, but that later proved to be false. So to your point, we still don't know the full sort of impact of that. And that's also something that providers have been looking at. Others who have plugged in, like other insurers that are plugged into United, have said that they, or rather to Change, have said they've moved away or made a more diverse makeup of their payment system. And so that is what could potentially impact United for the rest of the year. We'll definitely have to wait and see. But this kind of brings into focus the idea that these large vertically integrated systems like United Healthcare could be problematic. If one piece of that really large machine fails, what happens to the entire rest of the system? And we saw this pain really because including Medicare and the federal government are also plugged into the system, as Oregon Senator Ron Wyden said. He was pushing back on
the Change hack is a dire warning about the consequences of too big to fail megacorporations gobbling up larger and larger shares of the healthcare system. It is long past time to do a comprehensive scrub of UnitedHealth's anti-competitive practices, which likely prolonged the fallout from the hack.
And so this also brings into context the AI conversation, because we know healthcare is supposed to be one of those areas where AI is going to play a really large role, or looking to areas where it can. And this is why there's so much wariness around the topic, and some are saying it's just not time yet.
All right, a lot to continue to track here. Anjali Khemlani breaking it down for us here. Thanks so much, Anjali. Appreciate it. Coming up, auto insurance remains a sticky part of the ongoing inflation story. We'll talk to Root Insurance CEO Alex Tim about ways you can save. That's after the break. Let's do a check of the markets, sponsored by Tasty Trade here. Check of the markets, sponsored by Tasty Trade. Taking a look at the Dow Jones Industrial Average. It is the lone leader here on the day. It's up by about 0.2%. We'll be generous and round that off to the S&P 500 and the Nasdaq are lower right now. The S&P 500 down by about 0.4%. The Nasdaq Composite, you're seeing declines there by about 0.5%. Well, 317,000 former students of the Art Institutes are getting some relief today. The Biden administration announcing it's forgiving over $6 billion in student debt for those enrolled between 2004 and 2017. The Art Institute, which was a chain of for-profit schools that the U.S. Department of Education found to be making a, quote, pervasive and substantial misrepresentation to prospective students about employment rates, salaries, and career services. The White House releasing a statement today saying, quote, this institution falsified data, knowingly misled students, and cheated borrowers into taking on mountains of debt without leading to promising career prospects at the end of their studies. President Biden has made student debt forgiveness a cornerstone of his administration. In total, 4.6 million Americans have had the student debt canceled in the past 4 years. Well, we're also talking insurance here on the day. Auto insurance company Root out with quarterly results, showing the company continues to outperform with revenue beating estimates by over $55 million. Though, for customers, motor vehicle insurance, it remains a sticky part of the inflation story. Prices are up 20% year over year, and the average annual cost of full coverage for a safe driver with good credit is still almost $2,000. For more on all of this, we've got the CEO of Root Insurance, Alex Tim. Alex, great to have you here on the day, and thanks so much for taking some time here to break down what is a part of the inflationary story here. But you also remind that it's more than just drumming everything up to just inflation. There's parts of this auto insurance business here that adds up to the rising costs here. What is the more pronounced additive within this mix of costs that's pushing insurance premiums higher?
Yeah, and thanks for having us, Brad. We're excited to be here. As you said, we look at car insurance. It's one of the in terms of inflationary pressures this year. It's still rising incredibly fast. It's over 20% higher this year today than it was a year ago, and this is usually a top 5 customer expense. So this is really, a lot of households are really feeling this, and this is from increased parts. Parts are costing more. We're definitely seeing more technology inside of vehicles, and that technology is certainly more expensive to actually repair. And so all of those things are really driving up costs. We're also seeing a shortage of labor. We've seen really since 2019 about $10 an hour increase in wage rates for repair shops. That's leading also to long delays. It takes about 4.5 weeks, a little over 4.5 weeks today, to get a car repaired. And when you compare that to just pre-pandemic levels, that was under 2 weeks. And so there's just a huge amount of demand in the system and not enough supply. And so what you're seeing is really those prices come up quite a bit. And that's really what's driving a lot of the cost trends.
And Alex, we're going to get to some actionable tips for our viewers out there as well to hopefully be able to mitigate some of those rising costs here. But when we think about the new technology that you were talking about as well, it's hard not to think about electric vehicles, which are the most highly technological car that might be out there on the road. How have you seen that change the insurance landscape right now?
Those vehicles, they're very heavy. They're very advanced. A lot of those parts through supply chain disruption were harder to actually secure, so it made it even more difficult to repair a lot of those vehicles. That then usually ends up in leading costs. And I'll tell you too, those cars drive differently. One of the things we're seeing is that when you take a driver, and we can see this through our unique data and mobile technology. When you take a driver that's used to a gas-powered vehicle and they begin driving an electric vehicle, which can accelerate much faster, automatically brakes, right? They're driving. It actually takes them a while to get good at driving the electric vehicle. And so you also see this change in the actual driving behavior when you start to see folks, start to adopt electric vehicles.
It's interesting. Full self-driving has been one of the kind of hallmark features that's been touted around the future of driving as well. How do you see full self-driving changing the entire insurance landscape?
Well, I think we are very far away from full autonomy and truly full self-driving. However, what we are going to see, and we're continuing to see, is that the technology is going to keep getting better. And so we're going to live in this hybrid world for a very long time where sometimes vehicles are driving and sometimes people are driving. And, for insurance, that's going to really change the liability game, right? Sometimes maybe the vehicle manufacturer is going to be liable, and sometimes the consumer is going to be liable for those accidents. And for us, what's really important is that we know, when is that car driving? And by the way, when that car is driving, how is it driving? Not all of these vehicles and all of this autonomous vehicle technology is actually created the same. Some of these technologies are very good in certain situations, and they're not so good in other situations. So how is the consumer actually using that technology? When are they using it? All of that gives us a really rich view in terms of the risk, the underlying risk that individual is sort of undergoing in terms of whether or not they're getting into a car accident.
All right, Alex, just lastly while we have you, we got viewers out there that are saying, Brad, you promised me tips. Let's get to the tips here. What are some actionable tips that people can employ to hopefully bring down some of their auto insurance costs?
Yeah, I'd say the biggest thing is shop. One of the biggest secrets in the industry is there's a loyalty penalty. Most of the big guys right now that are out there, if you've been with your car insurance company for a long time, they just consistently raise their rates. They know you're probably not going to shop if they raise your rates 2%, 3%, 4% every year, but that really adds up over a longer period of time. So I would encourage you, shop, definitely try out Root. We provide the best rates for the best drivers. So if you're a good driver, we're a perfect fit for you.
Alex Tim, Root Insurance CEO, thanks so much for taking the time here with us today. Really appreciate it.
Thank you.
Coming up, everyone, we delve into the anxieties that small business owners are feeling in the face of inflation and how that could impact their vote in the upcoming election as well. That is next. A new survey from Goldman Sachs reveals 20% of small business owners are undecided when it comes to this November's presidential election. The survey gives a glimpse into the anxieties that small business owners they're feeling in the face of rising costs and inflation. Joining me now in studio, we have IXIC Pompey, who is the Goldman Sachs Global Head of Corporate Engagement, plus small business owner Geraldine Keogh, who is the owner of Dessert Ladies and Mien's Chocolate Centerpieces. Great to have you here this morning with us, and thanks so much for taking the time.
Great to be with you.
Absolutely. Let's dive into some of the survey results here, because this is really remarkable how many small business owners are really monitoring the impacts of inflation on their business and where that's also going to play into their decision going into November. Let's start off with some of the findings of the survey. What stuck out to you here?
Sure. First and foremost is around inflation, as you mentioned. Small business owners are feeling the bite of inflation. 71% of them say that inflationary pressures have actually increased in the last 3 months. And as we double-clicked on the drivers of that increase, we see the cost of rent has gone up, the cost of labor has gone up, the cost of goods and services have gone up. And I think, Brad, one important thing to underscore is at that intersection of inflation and small business is that small businesses feel the impact of inflation first, and they are relieved of it last. And so the cause of that is because they don't have the access to capital and the scale to really absorb those inflationary shocks. And so they feel the hangover of inflation far longer, which I'm sure Geraldine will attest to.
Absolutely.
And certainly one of those inputs as well for the business costs and the cost of goods sold that you have to consider is what the employment situation looks like too. I mean, wages being higher, and year over year, as we're thinking about what this employment and labor environment looks like, that makes it for small businesses harder to make sure that you're attracting and retaining talent as well to put a good or service out into the market.
100%, yeah. And we also, as small business owners, we feel very acutely the stresses that our employees are going under because of inflation, pressures. So we feel like we need to be able to answer that to a little bit to relieve their stress, because when they're doing well, we get a good product. Everything works. So that has been a big issue for us, labor costs, as many others. To be quite honest, it's been a rough, rough couple of years coming out of the pandemic. But right now with inflation, we call it death by 1,000 cuts, because just about everything is going up. The cost of raw materials, chocolate in my business up 15% this year, following a raise of 11% last year. That's a lot, and that is something that people buy with their excess income. And when that is cut, then that really does affect people in our industry. And it's a big billion-dollar industry, but it's we feel it at the very core level. Cost of labor, as I said, and then cost of raw materials in general. Just about everything we buy has increased dramatically, and then we are left with the situation: how much of this can we pass on to the consumer? Because before we hit that threshold where they just don't buy anything, and we try to navigate that space very distinctly.
To what extent are you seeing consumers push back right now on pricing that you do need to pass on?
Yeah. We find that the pivot to help them still buy, but buy less and buy smart is a big thing that, a strategy that we've employed in our businesses. And everything, it's not just the individual consumer, it's corporations that we're seeing this happen to as well, which is an interesting turn of events. Large corporations are also cutting their budgets and what they did. And, so we try to pivot with that and just offer better value and more ideas and, just a better way for them to be able to meet their needs.
A lot of small businesses like Geraldine's trying to figure out, okay, where do we see that infusion of capital if it's not coming in from the consumer that's willing to spend up and drive some of those profit margins that we may have been accustomed to previously and in past economic cycles. Where does that relationship with a major institution like Goldman Sachs step into play?
Well, certainly our educational program, Goldman Sachs 10,000 Small Businesses, is really infusing the sort of finance modules, operations modules to really help business owners navigate. And Geraldine is, of course, one of the graduates of the program. But also our Voices platform. We know that the private sector can do its part, business owners can do their part, but we need policymakers as well well to enact policies that are beneficial to small business owners who employ 61 million Americans. Now, what's interesting that Geraldine noted in terms of price increases is that our data shows that 50% of small business owners have been forced to increase their prices to really buttress the inflationary pressure. So they're a bit between a rock and a hard place, because when you increase prices, you're at risk of your profit margins, because how much are customers going to keep buying as the prices go up? So it's a tough situation for our small business owners.
You mentioned, and we kind of teased the top of this conversation with November and the general election, and how small business owners are thinking about their vote as it relates to agendas and policies that will be put forward and be able to be enacted that will positively affect small businesses out there. Is there a core message or a core agenda or policy that will move the needle for small business owners?
Well, you are touching on the key issue. Now, to level set, according to Gallup, small businesses are the most trusted group in America. More trusted than the church, more trusted than the military, more trusted than every single branch of government. So this is a tremendously strong base. Now, 96% of them say they plan to vote in November. So that's an interesting area that we should all focus on. Here's the issue. As you said, 1 in 5 of them are undecided. Now, why are they undecided? Here's what it comes down to. Neither party is talking enough about the exact question that you asked: small business policy. Small business owners are left wondering, who's got my best interest at mind? Because I'm not hearing any discussion about the things that keep me up at night. Regulatory policy, tax policy, reducing the bureaucracy around running a small business, access to capital, which is so critical. So what I'd say the message is loud and clear from our 10,000 small businesses community is that talk about the issues that matter to small businesses, because small businesses are going to be the swing vote potentially in this election.
Yeah, certainly. And Geraldine, I saw you nodding your head there a moment ago.
Absolutely, and 100%. When our politicians and our lawmakers get involved with small businesses and they talk to us and they ask us, what kind of support do we need? It's going to have an immediate impact on the local economy. When we are doing well, we're hiring people. We are all good to go. Everybody is, we're all firing on the same channels, but nobody's talking to us right now. I'm one of the undecided, I'll be honest, and I don't feel like we're being heard. Nobody's talking to us as to what can they help with, what can they prioritize. Obviously working on inflation would be huge, but we're not hearing it. There's so many other issues going on right now we can make as small business owners, we can make a direct impact to your local community that you serve. If you would talk to us and talk to other small businesses. On the weekend, go and stop in somewhere and ask the hard questions. How are you doing? What can I help with?
And sometimes
how can I support you?
It starts there. How are you doing as a small business owner? And especially as a customer, we can all do that. And it's very low-hanging fruit for us to do, just checking in on some of our local community small business owners. And many of us, our first jobs were in small businesses. I can attest to that. Thank you so much for joining us here today as well. We appreciate Asahi Pompey, who is the Goldman Sachs Global Head of Corporate Engagement, and small business owner Geraldine Keogh, owner of Dessert Ladies, NBN's chocolate centerpieces. Thanks so much.
Thank you for having us.
Absolutely. Switching gears here to Education Nation. Many high school seniors, they're about to graduate, make decisions about attending college here. Of course, big decision, and meanwhile, college seniors, they're about to graduate and embark on what will be, for some of them, their very first job. We've got you covered with some solid financial tips for those college grads. And here with more, we've got Holly O'Neill, Bank of America's president of retail banking. Holly, great to have you here on the program with us. I mean, many of us remember being in their shoes and in that position, ready to get into that first job and trying to figure out, okay, what are the key financial decisions that I need to make once I step foot in the door and get my key card or badge that should be synced to a phone by now, but it's not. Who knows when that's going to change? But what is the first thing that people should be thinking as they are taking on these new roles, fresh college graduates entering into the labor force?
Sure. Thanks, Brad, and thanks for having me. So not only do I talk about this professionally, but I have 2 graduates coming through in the next month, a high school and a college. So I'm having these conversations personally. And we've been talking about a handful of things: managing a budget, establishing a budget, managing savings, establishing credit, paying down your debt or student loans if you have them, and then maximizing employee benefits if you have a job and when you get a job, and then overall brushing up and learning, building that financial acumen. So it really is a handful of things and advice that we're giving to new graduates, whether it's high school or college.
What is the biggest pitfall that you usually see or typically have heard of among those who are getting out of high school or getting out of college and graduating and entering into the workforce and thinking back on what they would have done differently, perhaps?
So I think the first thing to tackle is establishing a realistic budget. That will set the course for you. That will set the path, being realistic about what your spending is. And we usually talk about some benchmarks, right? 50% of your income should go to the must-haves: rent, food. 30% can go to those things that you want and need: social activities, entertainment. And then the remaining 20% you should put to savings. And you should set that budget and set those thresholds based on your personal desires, so they can vary a little bit. But setting a realistic budget from the outset is incredibly important. I think the second thing is, when you have a job, maximizing those employee benefits that you have. Many employers match contributions to a 401k, and people should take advantage of that from the very onset, from the start, and that will set great habits as you move forward.
A rainy day fund. I mean, many of us hear about this, we talk about this. It's not fun to budget for, but how realistic is it for those who are just graduating, just getting that first job, to then say, okay, I need to start throwing some cash, throwing some money and some savings towards that rainy day fund? And what's a good percentage to start off with even?
Sure. Well, the emergency fund or the rainy day fund, we typically say ideally it's 3 to 6 months of living expenses. Usually that's very hard to achieve right out of the gate. So I always say start small, start with something, and start with something that you can repeat on a monthly basis. And the good news is, through some of the surveys that we've done with the Bank of America Institute and Better Money Habits, we know that Gen Zers are all saving for a rainy day fund. High levels of Gen Zers really value that. So the thought process is there, and I think the key is to just get that muscle memory going and start the savings. Sometimes it's hard. It can be $20 a week. Just start with something and then build your way forward.
Holly O'Neill, Bank of America's President of Retail Banking. Thanks so much for taking the time here today.
Thanks, Brad.
Absolutely. Everyone, we've got much more wealth on Yahoo Finance after the break. Stay tuned. With inflation staying high, investors are getting a reality check on the reality of rate cuts this year. And advisors are starting to hedge their bets with high-yield bond ETFs that have less interest rate risk. To break down if these ETFs are right for you, Todd Rosenbluth, who is the VettaFi head of research, is here as part of the ETF report brought to you by Invesco QQQ. Todd, great to speak with you as always here. Okay, so we're going into this Fed decision, and a lot of the conversation and the chatter has been, will they, won't they cut rates anytime soon? And if so, what does that look like for some of the ETF plays that are out there? How are you evaluating this?
So we at VettaFi often talk to advisors. In fact, we had a fixed income symposium a couple of weeks ago where we asked advisors about their views on rate cuts. And we were pleasantly surprised that advisors have come to expect maybe one rate cut to take place at some point during the second half of the year. And they're to take on risk through credit as opposed to taking on duration risk. So we asked the question of where the best opportunities were over the next 12 months. They chose high yield over investment grade. But as you mentioned earlier, we've seen flows into those short-term high yield ETFs. And that's not an oxymoron because less interest rate sensitive, higher yielding strategies from iShares, from State Street, from Invesco have been popular this year.
So with that in mind, where does this offer diversification for portfolios?
Right. So many investors are going to look towards high yield within their fixed income bucket, but when they have more risk tolerance. So an ETF like SHYG, which is the iShares short-term high yield bond ETF, which is the larger of those short-term high yield bond ETFs, you're going to take on additional credit risk exposure to double B rated bonds and single B rated bonds and get about 8% yield. With SJNK, which is the State Street product, you're going to get a similar yield, similar low duration, similar high income opportunities. And then these senior loan ETFs like BKLN, which is Invesco's product, even less interest rate risk. These are using floating rate bonds. But you'd have to be prepared to stomach the risk. There's volatility in high yield investing.
Why the ETF play then versus bonds?
Right. So you get the benefits of diversification. So an individual issuer that is speculative grade, that's rated double B or single B rated, could easily get further down and default. Whereas with an ETF, you get the benefits of diversification, hundreds of issues, hundreds of issuers spread across the credit spectrum, and it trades on an exchange the same way a stock does. So ETFs like SJNK, SHYG, and BKLN are great ways to get 8% yield in a diversified portfolio.
And then if we look out to 2025, where as we've been hearing more economists try to run the calculus of the probability of rate cuts this year, it seems increasingly like 2, maybe just 1. And if we did only see 2 or 1, then that pushes out the brunt of some of those cuts potentially to 2025. So what does that hold for the bond ETF strategy?
So if we're in a higher for longer environment, we found, and because the economy is strong, we're finding advisors and investors are willing to take on some credit risk, whether that's investment grade or high yield, and they're just not as comfortable taking on the same level of interest rate risk. So you certainly could go to longer term bonds, longer term treasury strategies like TLT, and we've seen some interest in that. But we think taking on credit risk, or at least we're hearing from advisors that they're more willing to do so, and you get the benefits. And I'd be remiss if I didn't mention there are actively managed high yield ETFs. T. Rowe Price has one in particular that has done quite well. We think investors can benefit from taking advantage of active management in this environment, depending upon the rate environment.
Todd Rosenbluth, who is the VettaFi head of research. Todd, great to see you. Thanks so much for taking the time.
Thank you.
Coming up, are you feeling burned out or stressed out about work? Well, maybe a 4-day work week is for you and me. I'll talk to an expert about the effectiveness of shortened work weeks next. Employee burnout became a huge topic of conversation around the pandemic in May 2021. The Future Forum conducted a global survey that found that 38% of workers feel burnt out at work. Now, that number is even higher at 42%. Since then, employees have looked for ways and employers have looked for ways to make work-life balance more of a priority. Enter the 4-day work week. Now, 30% of large U.S. companies are exploring new work schedules like the 4-day work weeks, according to a KPMG survey. Senator Bernie Sanders even introduced the 32-hour Workweek Act to reduce the standard work week from 40 to 32 hours over 4 years. But how effective is a shorter work week? Big question there for a lot of businesses. And here with some information, we've got Alex Pang, who is the 4-day work week global director of research here. Alex, thanks so much for joining us here on the day. Look, big topic that we've been trying to figure out how effective it is, how productive it is as well here. What are some of the initial findings?
So what we've seen with companies around the world in a variety of industries is that it benefits both employers as well as employees, that they're able to find ways of working more efficiently, collaborating and communicating better, even selling it to clients or customers. And and as a result, companies are able to stay as productive as they have been while boosting things like recruitment and retention, work-life balance, and reducing burnout and overwork.
Talk to us about some of the companies that you've seen this be effective for.
Sure. So, they range now from creative services companies, places where you could imagine being able to play around with time, to like hospital emergency rooms, and even the Golden, Colorado Police Department. So places that are working 24/7, very high stress, very demanding professional jobs. And in all of these, I think what we're finding are that there are ways of using technology better, of making improvements in things like meetings or the time that you spend at work in deep focused work versus versus other things that allow you to create time that you can give back to people while also making work time itself more productive and effective.
Okay, what does this mean for paychecks, for salaries out there? That's what a lot of people want to know. Am I going to be able to work for, say, from 40 down to 32 hours and still see the same type of paycheck?
That's a terrific question, Brad. And the companies we work with explicitly reduce working hours without cutting anyone's salary. And that's whether you are salaried worker or you're hourly. And the idea is that you're doing the same work, right? You're producing the same amount of stuff. It's just you're doing it in 4 days rather than 5. So there's really no reason to reduce salaries. And indeed, it provides a great incentive to, to find efficiencies, better ways of working, under that arrangement.
Alex Pang, 4-day week global director of research. I'm looking forward to more coming from these studies and cases where companies have found success, as a lot of other people are as well here. Alex, thanks so much for taking the time.
Thanks very much. Great to be with you.
Absolutely. Well, Tiger Woods is out with a brand new apparel and accessories line, Sunday Red, in a partnership with TaylorMade, featuring a brand new logo with 15 stripes on a tiger representing each of Woods' major wins. The golf company has already been providing the golf star with equipment since 2016, but this marks a brand new phase in the relationship between the two. I was able to catch up with the TaylorMade CEO, David Abelies, about the structure of this venture with golf's most famed icon.
But what is specialized and unique to Sunday Red is that this is an athlete partnered brand. This isn't an athlete endorsed brand. Those are two different things. Typically an endorsement deal is, here's a contractual obligation to say some nice things about our products and wear our products. From day one with Tiger, and if he were sitting here right next to us, he would acknowledge the same thing. From day one, we worked on every element of this brand, how it was going to be positioned, how Sunday Red is rooted in golf, but extends into what we call luxury and lifestyle markets over time, that Tiger would be intimately involved with the design and the development of the products, even down to the colorways, the fabrications, and the fit. So everything about Sunday Red encompasses not only the know-how that the broader holding company and TaylorMade can bring to market, from our global distribution capabilities, having a strong balance sheet to be able to invest behind this brand, but importantly, to bring Tiger's insights into product detail and design was critically important to us.
And make sure to keep tuning into Wealth This Week as we show more from my sit down with the TaylorMade CEO, David Abeliz. Well, that's it for today's show. Let's do a final check of the markets very briefly here as we're taking a look at the Dow, holding on to gains right now, up by about 0.3%. The S&P 500, that's down 0.3%. And the Nasdaq Composite also in the red by about 0.4% right now. Their eyes were watching Jerome. Of course, we're going to be staying tuned for the big FOMC decision to come at 2 p.m., the press conference at 2:30. We've got special Yahoo Finance coverage for you today on that. I'm Brad Smith. Thanks so much for watching Wealth. We'll see you at 11 a.m. tomorrow.